again, everyone. Ladies and gentlemen, thank you for coming. We should get started now, so may I ask that we all take our seats? Thank you very much. Please take your seats. We're about to get started. Thank you. Good morning again. Can we all take our seats? Thank you very much. I want to say good morning also to those who are joining us virtually. Thank you for your time. Hopefully this will be a very useful and informative session. You're all welcome to the Wealth Summit, hosted of course by Cordros Capital. My name is Wale Famerewa, and I have that pleasure of again hosting this event. I was here last year. I think it was valuable for those who were here last year. Please, with a show of hands, if you can just signify if you were here last year. I hope it was valuable, and I imagine that's one of the reasons you are here again this year. So, of course, we're going to be talking about wealth, and given all that is happening in the country right now, the economy, the Naira doing its thing, I think it's a very, very pertinent conversation to have. So we are going to be diving deep into wealth strategies, giving some new insights into how you can manage your wealth in these times. Again, I want to say a big thank you to the team at Cordros Capital for hosting. We are starting slightly behind schedule, so I would like us to just get right into it as I welcome to deliver some brief opening remarks. Director at Cordros Capital, please put your hands together. Please put your hands together for him as he comes, Mr. Mbanugo Undenze. A round of applause for him, please. Thank you.
Distinguished ladies and gentlemen, our esteemed guests, may I use this opportunity to express our appreciation and gratitude for your coming here today. You are aware that this is the second Wealth Summit, Cordros Second Wealth Summit. And if you are here last year, like the gentleman Wale said, you understand why we have this. I will also start by appreciating all the speakers, especially the keynote speaker, Mr. Elias Ibinekunzua, who is the Managing Director and Chief Executive Officer of Cordros, of Globus Bank. You're also aware that we have specialists in wealth management who will talk to us today on this. Like you all are aware, wealth management is not just about acquiring wealth, but about managing and growing your wealth. I will also thank all of you for coming here, because also we planned this occasion to be tomorrow, but Cordros being a customer-centric organization, we brought it forward, and you all made the effort to come. Thank you very much for that. We appreciate you. Looking around this morning, I can see a lot of people in the industry. And we normally have summits like this in the future, but this is the second time we are bringing stakeholders in the industry together. And we will want you to share ideas, interact, network for growing your wealth. Also, Cordros Capital continues as being a company that stood out for helping people grow and manage their wealth. And with these arrays of speakers, I hope we will do justice to the growth and wealth management. Please enjoy yourself and make the best of the summit. Thank you very much.
Thank you very much, Mr. Odenze, for that opening remark. And we would like to now move very swiftly to our first speaker as we invite the keynote speaker to deliver his thoughts on today's theme, the wealth revolution. So please put your hands together as I invite the MD Global Spank, Mr. Elias Ibina-Kenzwa, to the podium. A round of applause for him, please.
Good morning. I can hardly see the audience. The lights are beaming so forcefully. But let me recognize the GMD CEO of Cordros Group and other speakers here this morning, the industry chieftains that are here this morning, and the customers of Cordros Asset Management and the entire group that makes that group really thick. My name is Elias. That's already announced. I really don't know what qualified me to be the keynote speaker on a wealth revolution discussion. I would have thought that you would look for an Aliko Dangote or one of those worthy guys to come talk to you on wealth revolution. Or maybe you want to hear it from the. Yeah, okay. Maybe you want to hear it from the poor man's perspective, hence you chose me to speak to it. but I will try not to disappoint you. Let me begin by commending Cordros Group for this initiative. I wasn't here last year, but I got pillars as what transpired. It was well received, and hence we are seeing a repeat of it this year. I want to believe that it has become an annual event that would improve year on year. So I will be speaking to a few items on the content table. And I will try not to dwell too much on the slides, but speak the way we can follow. So wealth creation is the topic of the day. And in that wealth creation, we're looking at what has become a revolution in wealth management. And wealth creation we have defined as the process of accumulating assets, investments, and resources over a period of time. It is a journey that we set clear goals to achieve. And there is usually a roadmap from childhood to adolescence to maturity and then to passing over. Usually from the age of 18, when we are either leaving school or about leaving school, university, we start thinking of wealth. And we start thinking of careers. That's when the idea starts to resonate in us that we need to grow wealth or manage wealth. Some will grow what is there, manage to take it to the next level, while some will create afresh from nothing. So you have the first stage, which is the basic wealth protection stage, to wealth accumulation. When we are 35, 40, up to that 50, we are still gathering wealth as much as we can. But by the time you've done enough of that, you are crossing 60 and above, starting of how to pass on what you have and distribute that over time. So it is a process that is systematic, consistent, and cumulative. It's the art and science of managing your financial resources for comfortable future. And you ask yourself, what is really that future that we call comfortable? The future of good health, future of affluence, future of enough resources to meet your needs and perhaps do some philanthropy. So you must evaluate comprehensively what your future requirements are vis-a-vis your current state and what must be done to move you from where you are today to that envisaged future. So there are a lot of benefits to financial planning, which we know is a bedrock of wealth creation. If you don't plan your finances, wealth cannot come magically. It has to be deliberate, and you must work at it. One of the major benefits is that it gives you improved ability to manage your cash flow and achieve a better balance between expenses and revenue. One thing that has worked against many people in the wet journey is the inability to understand their cash flow properly and to isolate what's important from what is not, and be frugal enough to generate the kind of savings that can enhance their investment goals. But when you plan properly, you're able to separate these issues, and your journey becomes a lot easier. So you have increased savings that can optimize the growth that you have envisaged. Again, it will make your retirement a lot more comfortable and easier, because it won't hit you by surprise, and you will have put in place enough measures to take care of the issues that could arise during your retirement. It will also facilitate what we can call seamless transfer to generations. We've seen in an environment where a breadwinner goes or passes, leaving a lot for his next generation, and what is left behind becomes the source of problem for that generation, because there was no planning, there was no proper transfer of all the wealth accumulated, and that wealth becomes an issue. It's like what oil has done to Nigeria. When we had no oil, we were living on agricultural produce, we were doing well. But oil came and we dumped everything that was agric, and oil became what we sell, share the center, and we go and sleep. And today, we are having wars here and there, of course, tied to the oil issues, not just in Nigeria, but across many of the oil-producing countries. So the same thing you see when you fail to plan your finances. When you are there, it may look as if it's okay, but once you go, you're going to have crisis, because those who are going to start coming for those assets have no idea how it came, and they were not brought up to understand how to take it to the next level. So this is still on the financial planning process. It's a journey that we all must take carefully. From the beginning, you start by gathering information about you, the environment, your abilities, your skills, what you can turn to value that will generate wealth. Then up to when you are now able to review from time to time how your plans are going. So in the wealth creation dynamics, there are three major stakeholders. You have the wealth owner, you have the wealth creator, and you have the wealth managers. Today we have here with us, organizing this summit, called Asset Management, who are wealth managers. They are the last block. You have also in our midst people here who are entrepreneurs, and some are intrapreneurs. Okay? These are wealth creators. Oftentimes, we tend to think that only entrepreneurs are wealth creators. No. Like the Bible tells us that when we do what God has asked of us, and we contribute to humanity, we become co-creators with God. The same way, when you work with an entrepreneur, to create value that entrepreneur envisaged, you have become a co-creator of wealth. So you have the wealth creators being both entrepreneurs and entrepreneurs. And then the wealth owners could be entrepreneurs who own ideas, run businesses, and could also be people who are not there at all, but are members of the estate that owns the shares in those enterprises. So you find wealth owners, sometimes a wealth owner can also be, a wealth creator. But sometimes you can find a wealth owner who is not at all involved in the wealth creation stage. But by virtue of providence, inheritance, wealth has fallen on his or her lap. And the wealth remains with that wealth owner, while you have people who are creators, continuously adding value and taking that to the next level. So there are current trends that we see in the industry that I thought we should draw our attention to in the wealth creation dynamics. Research shows that we have about $90 billion that will be transferred from this generation to the millennials and Gen Z in the next few years. That is the transfer phenomenon. It's a great one. And we must understand the mindset, the thinking of the Gen Zs and the millennials. As wealth managers, you must move with the gorilla. You must understand those you are serving and how they think and where they are headed. And you must make the transfers as seamless as possible while ensuring that value keeps growing. Then you have the biggest revolution, in my view, which I refer to as digital assets. I will talk down the line more about digital assets to see the value and the impact it's having, and we must focus on how that will transform wealth creation going forward. So you can't overemphasize digitalization across the chain. It must be transformational. So any player that wants to remain relevant in the near future that is not embracing digital transformation and integration is on the reverse gear. I'm happy that Cordros Asset Management is at the forefront of this. They are aware of the skills required to serve next generation, and they are prepared, from what I hear, that they are going to be change agents in the process of this transformation. Of course, we must not ignore regulation. Regulation is key in the wealth creation dynamics. We need sanity to prevail as you create wealth. And that's where you have the regulatory scrutiny as a major block. We also must look at the cybersecurity issues. As we go high-tech, the superhighway of tech has a lot of bumps that we can't undermine or overlook. The level of fraud that we see coming from cyber issues today in Nigeria and globally is mind-boggling. And I'm sure the same will happen, if not already happening, in your industry. So there's need to prepare and to be very much aware of these challenges and put in place measures to safeguard the interest of your customers. So this is not what I sent to you to upload. It's different, yeah. Sorry, I mean they updated something different from what I updated. So it's can you please upload what I sent? Where's Bola on? Yeah, but it should be seen. Anyway, I think they went off detergent and sent something wrong. That's not what I uploaded, but sorry for that. I was going to speak more to what I actually term the revolution in the wet creation dynamics, which is the attention or the adequacy of focus that we are having on digital assets growth. To my mind, the greatest revolution in the wet creation dynamics today is what tech has done. You have today digital assets in the likes of crypto, the DeFi tokens, and the NFTs that are in hundreds of billions of dollars market cap. Historically, we all believed that the best store of wealth is physical assets, landed properties, and all that. We buy land appreciates. That is what we believe is the store of wealth. But today, that is changing. And Cordros Asset Management has defined the wealth revolution as new approaches to building wealth, such as innovative investment strategies, financial technologies, or emerging technologies. For example, the AI, renewable energy, biotech, and a few others. But I say that the wealth revolution is heavily imparting via technology. And today, I can break down for you, which is what I was looking for in the slide, what we have as market cap for just cryptocurrencies alone. Cryptocurrencies, three main types of crypto. You have the Bitcoin. The Bitcoin today has about 19.5 million in supply. And each Bitcoin today is valued at $30,000. So if you multiply that, you have a market cap of $585 billion US. I repeat, $585 billion US is what Bitcoin has today as market cap. And you have another type of crypto, the ETH, having $216 billion US in market cap. And then you have the stable coin. That's a bit small, but it's $82 billion US. Market cap. Then you have the DeFi tokens. Just about 7 DeFi tokens that are traded in the market today is worth about 16.6 billion US dollars. Then in NFTs, which is called non-fungible tokens, just one item, the OpenSea instrument alone is worth 100 billion US dollars, and there are several of such being traded. So what I gleaned out here, we are seeing over $1 trillion in market cap for digital assets. So I want to really call the attention of wealth managers, regulators in the capital and financial markets to pay more attention to what's happening in the digital world. We can't live in denial for too long. We've seen regulators trying to even criminalize digital asset accumulation. And I say wrongly so. The world is moving. In fact, the train has left. If you don't move with the train, you'll be left behind. Whether you are an asset manager, or you are a wealth creator, or you are a wealth owner, or a regulator in that space, we have to try to understand what is happening in that segment. I have seen or noticed what I may call intellectual laziness of the old folks like us. We are not eager to learn it anymore. We feel it's already, But no. If you don't learn, you will go out of fashion very easily, very quickly. So I call on the likes of the SEC, the CBN, whoever is playing in this space, to please take time, understand dynamics of digital assets, and try to make the best of it for the good of economics. Do you know how much tax can accrue to governments from a $1 trillion value across the globe? And what I called here 1 trillion is just a few estimates, not even the total market size. They are more than what I just read out. So if governments look at these critically, study dynamics, and know how best to use the resources available in the Gen Zs, we'll be better off as a people. And I dare say that cross-asset capital will make more money. You make more money from your activities. You pay more tax as well to government. And the asset owners also, the wealth owners, will have better value. But to set it aside and saying, oh, it may not be genuine or something is not right, may just mean leaving the pie of cake that would have been so nice to eat. And once it's gone forever. So I'd like to look at the dynamics of adoption and the impact is having on our growth and development. As you are very much aware, you have the ESG regulations and standards. You have, I've spoken to digital assets. I won't waste time on that again. You have the issue of economic volatility as a block. Across the globe today, economies are suffering from different issues. Growth is stunted. We are seeing extreme volatility across different economies. That is a challenge for wealth managers and even wealth creators as well. There's cyber issues. that we must also address. And there are fears, or not fears now, there's the likelihood of industry consolidation across the globe. You need to be a big player to make impact in the market. So we expect to see some players coming together to form a more formidable force. And all these would impact a lot depending on the level or priority of adoption. So you see some of these sectors or impacts having high impact in our businesses, but are having very low adoption priority. So there's need for us to create a quadrant and see where to prioritize our adoption processes as businesses and as individuals to see the impact they will have in our business. If you don't do that, you might be prioritizing less important issues that have minimal impact and leaving the core issues that have major impacts that can transform your business and even your own wealth as it is. So let me now go quickly to the role of the investor in this wealth revolution or wealth creation. I've talked about financial planning and how you should grow, your wealth over time and how you should apply, some discipline to that process. But you must, from day one, as an investor or a wealth creator, prioritize succession planning. You must think of who succeeds you and how can that person take what you've done to the next level. It's not enough to acquire wealth and just do and go, but you want that wealth to keep growing after you. So you must emphasize succession planning as an investor or a wealth creator. You must also prioritize asset allocation. You guys here would know more about portfolio balancing issues and how assets must be well allocated for you to have maximum effect on your portfolio. So high net worths must be mindful of how their assets are allocated, what they invest in, and then the kind of returns that come from there. And you must be mindful of legacy planning. What legacy are you leaving behind as an investor or a wealth creator or a wealth owner? What does, for instance, Aliko want to remember for, after all he's done in life as a wealth creator? That should, bother him. And that should inform the kind of plans he puts in place. And lastly, we see that philanthropy is done by wealth owners, sometimes very haphazardly. No, it has to be planned carefully. We've seen the likes of Bill Gates and a few others, create foundations for their philanthropy. We've seen a few of our rich men here do the same. But that's part of your wealth management process. And as asset managers, you must talk to your customers to understand the role that plays in their wealth creation dynamics and help them plan the kind of vehicles to be used to do philanthropy. It's not enough to just go out, okay, I donate this today and that. There should be a system to philanthropy that measures the impact of what you're doing to the entire ecosystem. And let me now go on to the role of the wealth managers. I have stressed the issue of technology that you can't ignore as a wealth manager. So as a wealth manager, you must retool, must reskill. You must be adept with modern technologies that will help you take your wealth management activities to a different level. Today we have the AI. AI is a new wave that none of us can ignore. Can predict the patterns of your high net worth individuals, and it can inform what you propose as solutions to them, and it can actually help them see you better as a value giver than just looking for funds here and there. So there are models that, as a wealth manager, you must seek to understand and adopt. And I won't go into those details here. But let me also say that you must be very mindful of regulation. But what used to be easy to forgive in the past, because values may not have been so much, will today be very material in terms of value. You may find that a little breach will cost you more than your entire shareholders' fund. We've seen in the US how fines are doled out in huge sums of dollars to people who violate regulation. So there's need for your compliance chiefs to be more alert to regulation and ensure that they uphold compliance to the highest standard. And there's need also for you to become a lot more customer-centric. This is time for you to do proper market segmentation, to say where or how do I apply the 80-20 rule in my business. You will find that 20% of your customer base will account for more than 80% of your volume. And you must focus intensely those segments. A lot of us have ignored certain segments of our population. We have often believed that the wealth owners are the men like us. But that is fading away gradually. The women are becoming heavy in the wealth ownership ladder. And I'm advising Cordros that the earlier you focus on that women's segment and create a special product for them, the earlier you will see impact and know that women are taking over from the men largely. And if you see the wealth that is being passed over in the next few years to the millennials, like I said, over 90 trillion US dollars. What is going to the women folk is more than half of that number. That's globally. In Nigeria, may not be far from it. So there's need to create a special space for the women. This is not me being, what they call that, gender, not gender balancing. It's about where your bread is. You know? As a businessman, look at where is my bread. Whether it's male or female, it doesn't bother you, but where is the bread? So I'm bringing your attention again to that segment, to create more activity for the women folk and attract their, win their confidence to do a lot more, in terms of your wealth management activities. So I want to round up by saying thank you for listening, and to say that I have not taken so much time so I don't bore you, but I've pointed out a few things that I think we should look at. And I'd like to reiterate or emphasize again the importance of digital asset space in our business, the need for regulators to look at that space properly and enhance the value that all stakeholders derive from that space. But that space is the future. That space is the revolution. And that space will determine who wins tomorrow. I thank you very much.
Many thanks to our keynote speaker. He's obviously a banker. He understands the flow of capital, the need for compliance, and of course, the opportunities. He has pointed out the women folks are a big opportunity, so I'm sure everyone who is in that space is listening. The wealth managers should know. Thank you again, sir. We'd like to now proceed to really get a better understanding of how wealth and investments are situated in the global economic landscape, and particularly in the Nigeria landscape. And we have the pleasure of having to deliver that Mr. Charles Robertson. He's the head of macro strategy at FIM Partners, all the way from London. Turn your attention now to the screen as we have Charles make this very insightful presentation on the global economy and more specifically how Nigeria fits into all of that.
Thank you so much for the invitation. I'm really grateful to be invited. I've had a huge interest in Nigeria for a very long time now, but also in actually trying to build some wealth. I'm looking after my mum's pensions. I'm looking after my kids' kind of university fees. I'm doing this at a personal level. Obviously doing it for the fund manager I work with at the moment, FIM Partners, Frontier Investment Management. They also do this stuff. And I'm trying to do it from a long-term perspective. How to sort out a pension or university fees, but also working for a fund manager means you're looking at a very short-term perspective sometimes too. So again, thank you for the introduction. I'm going to launch straight in, and I'm going to go straight to kind of trying to present my presentation to you all, and this should now be showing up. Free advert from me always about the book I wrote called The Time Traveling Economist. It's trying to understand what and why countries take off and where to invest in their trajectory. I'm not going to be able to hang around for the Q&A, I'm afraid. So if you've got questions, do email me. The email address is here at the front. And Cordros may well just send you the presentation as a PDF, so you've got the details. You don't have to write furious notes as I go through the presentation. So my big picture is this slightly complicated graph. And what it's trying to show you is how close the link is between the US dollar and how investors treat emerging and frontier markets relative to developed markets. So the grey line on the right-hand side is the dollar. And when the grey line is low, it's showing you a really strong dollar. So 1985 was a madly strong dollar, like twice as strong as the dollar is now. And we all know the dollar is quite strong now. And when it's high, we've got a very weak dollar, which is what we had, say, back in 2008, 2011, 2012. The red line on the left-hand scale is showing you the relative valuation of developed markets to emerging markets. So when the red line's low, which is when the dollar's strong, by the way, when the red line is low, what it's telling you is that people hate emerging markets. They love developed markets. They love the US stock market. They hate emerging and frontier markets. And the link between these two is really strong. Now, what's interesting about the last 10, 12 years is that we have had one of the longest periods of dollar strengthening and emerging market weakness relative to developed markets that we've had in 50 or 60 years. This, I am sure, is not going to last. So I've got some of my mum's money in emerging market equities because I think we are at a point now where the relative valuation is compelling in favor of emerging and frontier. But I just want to take you through a few examples over the last 50 years of what we have seen happen at this point, at these points in the cycle. So mid-80s, we get the dollar going really strong. Why? Because US rates were very high. The US budget deficit was pretty big, and people didn't like emerging markets, which were defaulting. The Latin American debt crisis, which struck Nigeria really hard too in the mid-80s, was because the dollar was so strong. And no one wanted to be in emerging. But you can see in 1986, when the dollar's begun to turn weaker, the grey line's begun to turn weaker, and 1986 actually was the best time to be looking at emerging markets. Emerging markets as an asset class, I think, only began in 1987. That's when the term got coined. And you should have been actually investing in emerging markets from 87 up to about 95, 96, because they outperformed developed massively. When we get to 99, 2000, the narrative is emerging markets are a disaster. Asian crisis is bringing down Southeast Asia. Thailand's in disaster. Korea's a disaster. Brazil's devaluing. Russia's defaulting. You only want to be in America, right? Because America's got tech. America's got Google and Amazon, all these exciting new tech stories. And emerging markets are awful. That's the narrative in the year 2000, 2001. And yet, that was the time to be investing into emerging markets, because over the next 10 years, they massively outperformed the US. And by 2012, where are we at? By 2012, emerging markets are the best thing in the world. Put all your money into emerging markets. China's going to grow. Gazprom will be the biggest company in the world. That's what Gazprom thought anyway. And you know, why would you be in America? They just had a global financial crisis. What a disaster. All the banks are a failure. They'd have to be bailed out by the state. And yet actually 2012, you wanted to go long America and short EM. And that's been the trade that's working for 10 years. So where are we at today? We're at tech is where it's at, even if there's been a bit of weakness in the last week or two. Tech is where it's at. NVIDIA, AI, America's ahead of the game. It's the best. Emerging markets, defaults in some countries, and China's property problems, and you name it, you don't want to be in emerging markets. So I think big picture, if you're trying to protect your wealth on a 5 or 10 year view, this is the time to own exposure in EM and frontier. And frontier, which includes African equity markets like Kenya and Nigeria, is like a beta. It's like a high value added beta on that trade. So if you really hate emerging markets, then you really, really don't like Africa. And that's what we see in a lot of the markets I love at the moment, unfortunately. And when emerging markets are great, that's when you get the Africa Rising front cover on The Economist. So that's the big picture from my side. I'm looking for dollar weakness. I'm looking for a trade out of US equities over a 5-year view, maybe a 10-year view, and into emerging markets. But I'm a bit worried by Trump. And I'm worried about him because a lot of what he's talking about suggests even more dollar strength. He's talking about tax cuts, which give us budget deficits, which keeps the Fed funds high, as it happened in the early 80s. This graph here is trying to show you in blue the budget deficit getting much worse in the early 80s than it had ever done before. And the US interest rates had to be very high. Now, we're at even worse budget deficits now than we were then. And the dollar is strong. He wants tariffs on everyone. He wants less immigration. It's all about higher growth for him. All reasons to worry that we could actually be in a dollar strength story. So I am positioned for EM to do better because history is telling me that's kind of what happens. The narrative is never clear at this point that you should do that. And sure enough, the narrative is not clear that you should be long EM today either. But, and this is my worry. So I'm throwing this out because US elections are up there in November and it just adds some more volatility for us. So what have we got in our economies? We've got three problems. China's not lending like they did. They lent $1 trillion to the Belt and Road Initiative. They lent 30 billion just to Africa alone a few years back in 1 year. Now they're lending zero net. They're taking more money back than they're lending. Global rates are still high. The green and the red lines are the US and Germany, and they were tracking Japan with a kind of 25-year lag really well up until a few years ago, up until 2022, and now that linkage is completely broken down. And debt levels are high. So it's not easy to love emerging markets given that, and I understand that. What else is happening that's relevant? Okay. Every presentation I've ever given in a place like Russia, or indeed Nigeria, people are always interested in the dollar and oil. And I believe those two things are the most difficult to forecast. The dollar, because in real terms, real trade in the US, like of goods, the stuff we might buy from the Americans or what they might sell to us, whatever, that's a tiny proportion of total FX trade. On a daily basis, we're getting trillions traded. And that's about sentiment. And sentiment is, you're trying to forecast what everybody in the world is feeling and thinking about the dollar. It's very complicated. What I can say to you is that the Bloomberg consensus forecasts from early July and the forward markets are looking for dollar weakness, which does support that original first slide I showed you. On oil, again, we've had a bit of weakness recently. Global manufacturing is a bit weak. And if you look on the forwards or what analysts are forecasting, we're not looking for much pickup. I think the Saudis are trying very hard to keep oil around. I think 85 to 90 is their goal. And they've done a really good job on that since about 2015-16. So as a baseline, fairly comfortable with oil being stable. Just to warn you, the US Treasury Secretary, the new one, the guy who would come in if Trump wins, it could be this guy called Besant. He's quite smart, economic historian, runs a macro hedge fund. He says, let's get US oil output up by 3 million barrels a day. That's more than double what Nigeria is producing right now. And he was saying if oil can be crashed down to $40, $50, good for America, bad for Putin and Iran. I don't really think 3 million barrels a day would make that difference, assuming it was built up over 4 years. So you'd have to believe the IEA, who thinks that oil demand is going to go negative in a few years' time. I don't. So my base case is, let's say 80 to 90, the Saudis keep it there, maybe downside risk of 70. I don't believe in the $40 to $50 oil story. Global growth, it's all right. I mean, US is expected to slow down next year to about 1.8. The 2024 forecasts have only recently, in the last month, begun to fall. For a year, growth expectations for America have been rising and rising and rising. If you go back a year, 12 months, 14 months, people expected growth in the US to be 0.6% this year. Now they're saying 2.3. That's a huge improvement. But they were saying 2.4 a month ago. So people are beginning to say, actually, maybe America might not be in a great spot, or not. It's not accelerating from here anymore. On inflation also, it's come down a little bit. The inflation expectations have come down a tiny bit. So at the margin, in terms of where we're going for the next few months, slightly weaker America might be part of the story. And that then supports the view on the right-hand side that Fed funds are going to be cut. But let's say two cuts this in 2024, possibly 3, and then a cut also, more cuts into 2024. So again, like slight improvement actually in terms of market story. What's happened for a lot of our key markets? Dollar bonds had a crucifyingly bad 2022, and they collapsed. Prices of dollar bonds in Egypt and Ghana and Nigeria were at 100 cents on the dollar and crashed to kind of 75 cents or even as low as 25, 30 cents in a whole host of markets in 2022-23. We are now in a better place because the IMF has been really supportive of nearly everyone. Anyone who wants money from the IMF, they've basically given it. We've also seen policy shifts that I think are really quite helpful. Weaker currencies, austerity, it's painful, really painful. And you've seen how painful in Kenya with the riots that we had recently. But nonetheless, these are steps in the right direction. So the immediate kind of default worries have lessened. What I'm going to try and run you through now very briefly is just some of the stuff I was talking about in the book about what enables countries to take off. And the reason I'm going to do that is to explain why we got into that default worry for last year and why the default risk hasn't disappeared and what this then means for the currency. I promise you I will get to the Naira and talk about it perhaps even more than you want. So education, electricity and savings are absolutely key. That's what countries need to take off. Education first, has to come first. And then electricity and savings come later. And I'll explain how. There's about 5 countries out of 200 that don't fit the thesis. Places like Argentina, Venezuela, Sri Lanka, Lebanon, and possibly South Africa. They don't fit very well with this thesis, but for the other 195 countries, including Nigeria, it really works. And the first point is about education. There's been lots of research that shows if you haven't got 70 to 80% adult literacy, you cannot industrialize. And adult literacy means, can you say farming is hard work? Sorry, can you read and write farming is hard work in any language? And if you could do that in about 4 other sentences, equally simple, you're considered to be literate. And you need 70 to 80% to industrialize. That has been true forever. England and Scotland were quite quick, about the first to get there, which is why they had the Industrial Revolution first, and Germany, France, and so on followed. When we look at the inheritance that Africa got from the imperial powers, they walked into independence, most countries around 1960, with less than 40% adult literacy. You can't even grow sustainably with less than 40%. And that's why so much of the 20th century was just lost decades. The situation in recent years has got vastly better. Many, many more countries are over 70% adult literacy. Nigeria's not there, it's about 62%. But it's obviously hugely improved compared even to 30 years ago. So if I show you a quick map of Africa, what you've got here is green countries with 70 to 80% literacy. 80% is dark green. And the picture overall looks pretty good. Grey, it's under 40%. You can't even grow sustainably. And why are we getting coups in places like Mali or Niger, civil conflicts and strife in South Sudan, Somalia? It's because the literacy rates are sub 40%. They can't grow sustainably. Now, I've done it by state for Nigeria, just to show that really we're talking in Nigeria about two different countries. Lagos, the south, has got the adult education it needs, the literacy it needs to industrialize. It's great. It's a fantastic story. The north, unfortunately, is decades behind, and that's not going to change fast. Once you've got your literate population, what do you then need? You put them into a factory, textile mill. It's what the English did. It's what the Japanese did. It's what everyone does. The Chinese did. You put them in a textile mill. They need power for that textile mill to work. And the grey are countries where you're very far from the level of power needed to make that factory work. So countries that can industrialize, that have the human capital and the electricity, countries like South Africa at the bottom, they do actually, despite the stories about power cuts, they have enough power to have a car industry. And they export their cars to Europe. Morocco, same story. Good story, industrializing now. Mauritius, tiny little thing on the bottom right-hand corner. There we are. They can do it too. They've been doing it for decades. Egypt is ready to go. Nigeria's not there yet. So I look at a country like Nigeria and I look at exports per person. And because the country can't industrialize yet, exports per person haven't risen in 50 years. Nigerians in 1970s were selling the light blue line. I don't know if you can see that very well, but we're selling about $750 per person of exports. And now we're at about $250 per person. That's because oil production hasn't improved since the 70s, but the population's got a lot bigger, and there hasn't been a diversification. So why hasn't there been electricity? Why isn't there enough power? Now, there's a lot of reasons given for this, but I think the most important is interest rates. This is trying to show you may not be able to see it clearly, but this is trying to show you what the cost of electricity is. Doesn't matter whether it's coal or gas or wind. In a set of countries on the top at 10% interest rates, and the same countries below at 3% interest rates. Basically, the cost of power is vastly more expensive if your interest rates are high. And you just can't afford it if you haven't got a lot of savings. Where are interest rates high? They're in the countries that I showed you didn't have enough power. Angola, Egypt, Kenya, Nigeria, Pakistan. And but it's not an African story because Pakistan's in there too. It's well, I'll get to why it's happening in a second. But what you can see is countries like Mauritius or Morocco have interest rates of like 3%. Now they can borrow to build electricity, to build great roads. If you've done the flight, as I've done from Lagos to London via Casablanca, if you've ever got out at Casablanca, you will see amazing infrastructure. That's because their interest rates are 3%. And that then enables them to industrialize. So the weird link that I had never seen until about 5 years ago is the link between fertility rates. This is pretty controversial stuff, I know, but between fertility rates and savings in the banking system. And I simplify it on the right-hand side. If you've got 5 to 6 kids, your bank deposits are 20% of GDP. If you've got 2 to 3 kids, your bank deposits are 50 to 60% of GDP. And your interest rates are lower. So you've got more savings at lower cost. And the consequence of all of this is, well, you can see on the kind of the left-hand side, that because of high fertility, we just don't have many savings in the countries that, well, at least that I care about so much. And if I show you a map of Africa then on fertility, countries that are looking great because they've got low fertility, countries like Morocco, which had less than 3 kids since 1999, what does that mean? On average, it means your average family can save a bit of money in the bank on a Friday night. But when the fertility rate's at 5 or more in countries like Nigeria, or Congo, or Angola, most people have got no savings on a Friday night in the banks. So the consequence of that is, if the banks have got no deposits, they also can't lend very much money. They can only lend, in Nigeria's case, about 20% of GDP in the middle there. And you'll notice that all the countries with low lending, Tanzania, Uganda, Zambia, Pakistan on the right-hand side, have high fertility rates. And the countries with loads of lending, Morocco, Mauritius, Tunisia, South Africa, they're all low fertility countries. I'm going to come back to an issue about this in a minute, because it puts governments under pressure. And that's why they've borrowed money. That's why interest rates. So anyway, we'll get to that in a second. So the UN's just come out with new forecasts for the demographic transition. And you can see on the left-hand side, when did countries get their fertility rate below 3? Mauritius, very successful economy now. Back in the 80s, it was seen as a colony of the IMF. But because fertility was dropping below 3, their savings grew, they didn't need the IMF anymore. They've become the second richest country in Africa. Morocco, industrializing story, because its fertility rate dropped below 3 in 1999. Egypt is now still looking at the IMF for help, like Mauritius was in the early 80s, but it's in a much, much stronger position. Kenya is going to be in a good position 2029. The UN forecast now, Nigeria, 2042, it's going to be, it's when life gets easier. I know that's a really long time away. It doesn't mean you don't invest in some interesting points in the cycle, and I'm going to get to that on the Naira in a minute, on Nigeria. It just means be cautious. It's not going to be a 20, 30-year fantastic story forever. It tells you we're going to see emigration, because what happens in countries with high fertility and not many savings? Well, you're talking about Europe in the 19th century. And what did the Europeans do? They left. They went for America, they went to Australia, they went to Argentina, South Africa, they went anywhere, because there wasn't enough jobs at home. The Irish were doing it 50, 70 years ago. The Filipinos were doing it 20 years ago. And today it's the Nigerians going to Canada, the Japa movement, it's the Ugandans going to Dubai. It's going to carry on for decades. That's a given. It only stops happening when you get to about $10,000 per capita GDP. Then people say, you know what? My quality of life is actually quite good at home. I'm going to stay, but we're very far from that. How do you get fertility rates down? Well, I'm not going to focus on this. This isn't the point of today's session, but just for your interest or perhaps knowledge, under 5 mortality rates is really key. The people have a lot of kids partly because they lose their kids. It happened to my family. If you go back to when UK was high fertility, you can see it in my family tree. 8 kids from my great-great-grandparents, 3 of them died before the age of 10. And as a result, but they then ended up having 8 kids in all. So if you prioritize health and health spending, and if you educate girls, the fertility rates come down, savings go up, interest rates go down, and so on. It's a good story. This does all impact on growth, by the way. If half your population are kids in dark blue, bottom left, then they shouldn't be working, paying taxes, earning an income. They should be at school. And only half the population can actually be out there working and paying taxes. And that means quite a lot of pressure on you to try and pay taxes, because the kids aren't paying any. It's much easier in a country like Asia, not a country, continent like Asia, where you've got 70% of the population are now adults and paying taxes and so on. Less problematic for them. And it creates some odd numbers. We talk about the problem of too low fertility rate, places like China. Well, right now, the Chinese, if you take average 10 Chinese people, sampled correctly across their age groups, you have got 6.5 working age adults. In Ghana, young Ghana, it's 5 out of 10. So actually there's more working age people in aging China, or even aging Greece, which I was really surprised by, bottom left. There's more working age people in aging Greece than there is in young Ghana, for example. So if half your population can't work, what's your growth rate? Well, I show this on the yellow bars. And if you've got one working age adult per kid or pensioner, you grow on average at 1.4% a year per person. And when you've got 2 or 2.5 on the right-hand side, 2 to 2.5 adults per kid or pensioner, you grow at 4 or 5%. And there's no prizes for guessing that it's Asia which is giving you that very high growth at the moment, because their demographic structure is so good right now. And I kind of show that in these graphs. This is the same thing, the ratio of adults, working age adults to kids or pensioners. And you look at Vietnam or Korea. So Korea, rubbish in the 1970s. You do not want to be in Korea in the 1970s. 1.2 adults per kid or pensioner. But it then shoots up to 2.4 through the late 90s. That's when you want to buy Samsung. That's when you want to be investing in Daewoo and getting into that Korean growth story. Now that's turned. We're heading lower. Still good numbers in Korea, but it's heading lower. It's now Vietnam, which is the exciting high ratio of adults, working age adults. Or it's Philippines. Philippines is looking better and better, while China's now in decline. And then I look at kind of Saudi Arabia, huge numbers of adults there, and they've stopped having loads of kids as well. While Nigeria, you can see we're on the uptrend now in Nigeria, but we're still at kind of 1.3 adults per kid or pensioner, and we really want to be up there at 2.5, and we're going to get there, but well, not for a long time, possibly beyond my lifetime anyway. And into Kenya's going to get there quicker. Anyway, that's kind of giving you a big picture of emerging versus frontier on that. Developed, by the way, pretty awful. I mean, we are now in the opposite problem. Too many, a growing number of pensioners, not enough kids. And Italy and Japan looks really bad. Hong Kong is getting, it's okay for today, but wow, it's going to be in a very bad place in about 10 years or so. France and Germany, not great. US and UK, bit better. Why? Because the US and the UK have brought in a lot more immigration. Now, the only trouble for them is that that's created a political backlash. We saw it with Brexit. We see it with Trump. And so we don't know how long. Well, we know the numbers are going to stay better for decades than Germany and France or Italy and Japan. So if you're going to be in developed market assets, I think the UK and the US are going to have this helpful tailwind for much, much longer, for decades to come, and equities ought to price in decades to come. I'm at risk of overrunning, and I promised to talk to you about the Naira. I'm going to get there quite soon. So, when I kind of just show, right, let's take a group of countries to potentially invest in, the ones that are going to give you the highest per capita GDP growth, where the middle class is going to double every 10 to 15 years, countries like Indonesia, Philippines, Thailand, although it's getting old quite fast, so this isn't going to, I should have done this to 2030, it doesn't look quite so good for Thailand. But anyway, Indonesia's great, Philippines is great, Vietnam's great, India's great. Everyone's already invested in India though. Saudi's really good, surprisingly. UAE is good. If you own property in Dubai, well done. It's a good story. It's going to last a long time. Sub-Sahara, it's going to be harder. It's going to be harder. So, simplest way of understanding where we're at in terms of, do you just put your money into a country and just leave it there for 10 years, it's just going to do fine, is look at your average age. The median age in Nigeria is 18, and like most 18-year-olds, isn't flush with cash. At least not like my 18-year-old, she's not. You want to be in your mid-20s, late 20s. That's when you should be in the double demographic dividend. Lots of working age people, plenty of savings. It's a great story. And then it gets a bit more complicated again for the oldies, the oldie countries like Japan and Italy and Greece and so on the right-hand side. So where I find it easiest to recommend is getting exposure on the equity side for just these long-term growth stories of the double demographic dividend, the Southeast Asians and stuff. And it's partly why I joined the fund manager I'm at, is they've got a fund that does just that. So what about resources and commodities? Do we really need people to have smaller families? Can't oil save us? Can't diamonds save us in Botswana or whatever? Yes, if you're Botswana, diamonds make a huge difference. But you've got to look at your commodity exports as relative to your population size. And Nigeria's on the right-hand side there, exporting about 5 barrels of oil, net exports of 5 barrels of oil per 1,000 people a day. So the oil price is what, around $80 times 5 is $400 a day for 1,000 people in Nigeria. So that's about 40 cents each a day. But half of that has to go to the oil companies, surely. So we're talking 20 cents a day, 7 days a week. So we're talking $1.40. That won't buy you half a cup of coffee in London anymore. $1.40 a week per person. It's just not enough to really make a difference. But lucky old UAE and Qatar, Norway, places with no people, basically, quite a lot of oil, are in a much better place. And I just, as a reference to give you some sense of scale, I keep on seeing on Twitter people saying, why aren't we using our oil wealth properly, like Dubai did? The difference between the oil wealth that Dubai had when it built up the city that is now so impressive, and say a Nigeria or even a Saudi, Dubai's just off the scale. They were producing 6,000 barrels per day compared to Nigeria's 4. I mean, no wonder they had the money to build Dubai. It's just not something which most countries ever are lucky enough to have. So, the reason I'm talking about all this is because we've run into debt problems, and these debt problems have hit you, and will continue to be a challenge. And why have they happened? Because I think governments don't understand why they have the savings shortages they do. Most people have not read my book. If most people have read my book, maybe that would change things, but they haven't. So they look at, you're sitting there as a policymaker in Kenya 10 years ago, and you say, why aren't we growing as fast as India? And you don't recognize it's to do with fertility rates, which in India are really low, by the way. You just say, well, okay, let's borrow some money so we do grow like India. And they've done that. And Kenyan debt to revenues has doubled from 200% to 400% in just 10 years. And in Nigeria, we've gone from 150% to nearly 500% last year. Now, the IMF thinks that's going to come down a bit this year. Let's hope so. But we're really at kind of peak debt in terms of what governments can afford to service. And that means problems, because it means people are pricing in some default risk. It means governments are coming after you for tax because they've got to improve the revenue denominator on that ratio, and they've got to try and cut those budget deficits. And I, if there's one thing which I'm pretty sure about is that the tax pressure isn't going to disappear anytime soon. In Pakistan, it's causing huge controversy. In Kenya, which is already at something like 17% of GDP is collected in Kenya, and it was going to go up to 20 or 25. Kenya said no, in like a very dramatic way. Nigeria just doesn't pay any tax at all. I mean, compared to a place like Kenya, it's 10% of GDP. But you know that is not a 10% of GDP which is taxed fairly across the country. Everyone's paying it. They're not. It's coming at you in Lagos because that's where a bit more money is. Because I would argue it's the most educated, advanced part of the economy, and therefore makes more money. So anyway, that's just something you need to be cognizant of. This isn't going to disappear, this tax pressure, and the tax to GDP ratio is going to need to rise. Now, where I'm going to get to the Naira is, what can a government do to try and reduce the interest burden of all that debt that's been taken on? And the unfairness of life is that if you are low income, it's harder to borrow money. It's more expensive to borrow money than if you're high income. And this applies if you go to the bank manager and say, like, I've got 10 Naira in the bank, will you lend me 100? First of all, he'll say no. And secondly, he'll say, this is the interest rate, super high. It's the same with a country. And if you go with $1,000 in your bank account and ask to borrow 100 Naira, yeah, of course, how much do you want? And the interest rate will be lower. That's true of countries too. If you've got big banking deposits in your system, because your fertility rate's low, all the countries on the right-hand side of this complicated chart, all of them have got low fertility rates. That's why they've got such high savings. They pay zero real interest rates. But if you're on the left-hand side, your fertility rate's high, we know that, and you pay the highest real interest rates in the world. Unless you run a current account surplus. If you run a current account surplus, that means you've got more dollars coming into your economy than going out of your economy, and that helps reduce interest rates. If you're running a current account deficit, then not only do you not have any savings, but any savings you do have are being spent on imports. They're leaving the country. So Emefiele's policies meant effectively high real interest rates. It was hidden, of course, by a lot of manipulation of the markets, but the reality was that this wasn't helping investment. If you have a cheap enough currency that your current account's in surplus, then your real interest rates can be zero, just like countries with lots of wealth. So, promise to get to the Naira. This is close to the end of the presentation now. What's happened is that if you go back 2 or 3 years ago, and this is another complicated table of mine, but the key figure is right in the middle. It's the long-term average divided by the current rate. So the long-term average Naira should be 950 today. 950 Naira to the dollar, that's fair value. If we were too strong, we'd be at 800, 700 to the dollar today. Fair value is 950, and on the 25th of July, when I dated this, we were at 1,590. Super cheap. So the key middle column is telling us that the Naira is 40% weaker than its long-term 25-year average. And that, by the way, on the 25th of July, was the weakest currency on the planet, at least of the 80 countries I look at. And Japanese yen was the closest to being that weak. I mean, it's really weird. You just don't see this. Currencies are normally 20% cheap. You don't need to be 40% cheap. This is really weird. The current account, the IMF says, is going into surplus in 2024. So that should be supportive of the currency being a bit stronger than it is now. The problem, I think, has been 1 year local currency yields. They're still negative. Real interest rates the most negative in frontier markets or in Africa. And I think that's been the problem. So hence the central bank hiking rates. But what this is telling me is we've actually got a compellingly cheap Naira at the moment. And it should be like 20, 30% stronger than it is. So where do we go from here? Now, economists don't like to give you one answer, not when it comes to a forecast. They prefer to give you at least three. I'm giving you kind of three here. The best case scenario for the currency over the next 5 years is the middle scenario. Consensus is expecting inflation to be about 32%. If consensus is right, that we drop to 15% next year, 9% the year after, then fair value, my fair value, which I'm telling you is about 950, that will move. It has to move with inflation. So fair value by the end of 2024 will be about 1250. By the end of 2025 will be about 1350. And by the end of 2027 we'll be at 1550. So weirdly, even with all the inflation the consensus is expecting in the next 4 or 5 years, the Naira today, on the 25th of July, is actually weaker than where it should be in 4 years' time. That's how cheap the Naira is. So I think it's, if you're ever going to be in this currency, it's an interesting time to be in it right now. Could it all go wrong? Yes, it could. We could find that the central bank can't control inflation. It's 40% next year, 45 the year after, 50 the year after, and actually they can't control inflation because they can't get the fiscal under control. And that debt to revenues ratio doesn't get better. It gets worse. And we end up in default in 2027, 28. In that scenario, the dark spot NGN rate at the bottom, we're at 4,800 to the Naira, a Naira to the dollar in 27. And maybe halves then to about nearly 9,000 in 2028. That's if the government can't sort out the fiscal side. And if you looked back at Nigerian history, you'd reckon actually there's a chance the currency goes too strong, because that usually happens. We had it in the 90s. We had it again after the global financial crisis for a little bit. And then we also had it massively under Emefiele. So we could end up back at 1,000 and staying there even in 3 years' time. The dollar returns you make from being in Nigerian assets then is incredible. Like they double. In dollar terms, you go up 100% return in 4 years. But it will end badly, because it always does. So I guess what I'm trying to conclude here is we are not in an industrializing, long-term currencies getting stronger most of the time, which is what the Asian story's been for 20, 25 years. We can't be in that story yet, because we're not industrializing yet. And the consequence of that is the currencies can't strengthen over time. So in a place like Pakistan, it kind of just sits around fair, the black line is just like the average. What we get in Nigeria or Egypt is much more volatility. And the time to be in assets like Nigerian equities or Egyptian equities or stuff that I think are really interesting right now is now, when we've seen a big sell-off in the currency, which is what the right-hand chart is telling you. That's where we're at now. And we're seeing it on equities. I look at Nigerian equities right now. Turn it into dollars, the NGX all share. We're less than half of the 20-year average. Nigeria's not getting worse on an average year. On an average year, actually, the population's getting a little bit better. On average, educated, because more kids are at school, literacy rates are improving. Youth and dynamism is helpful. I think we're, again, one of the cheapest points we could possibly be to be looking at these assets. So what happens next? I'm going to chosen this picture because 2 hands up is basically saying I'm not 100% sure. That's fair. I mean, I would argue I'm still looking for about 1,200 to the dollar. for the end of this year. I know it looks insane today, but I think if the Fed's cutting enough, if oil production's okay, picks up a little bit, oil prices stay roughly stable, I think it's plausible. Bigger picture than that, I do think EM, particularly Frontier, is looking really, really, really cheap. And markets like Nigeria and Egypt in particular looking very, very interesting. My fund itself, are we overweight Nigerian bonds or the Naira? No, not today. I keep on looking at it every day and thinking about this, but I just want to have a bit more confidence on the fiscal. Are we going to get some tax rises to match the extra spending that Tinubu's pushing through Parliament? Higher oil production, that would help. Positive real interest rates, helping, moving in that direction. But I'm very keen to get more exposure. So, look, I do hope that was useful. I'm sure I've raised a million questions. I'm going to stop there. I mean, there's some other big picture slides, but that's history stuff. Good luck and all the best, and I hope the rest of the day is interesting. I hope I haven't caused too much controversy, but just enough to make lunch interesting for you. And I hope to see you in person one day soon. Thank you very much indeed for the time, and I apologize.
CEO of CFG Advisory, Mr. Tilewa Adebajo, to give his perspective on the economy. He will, in his case, take questions. He is in the room now. So I'd like to invite him to the stage now. Mr. Adebajo, please, a round of applause for him as he steps forward. And as he does, we are going to also make this interactive. So we would allow you to ask your questions, and there will be something on the screen shortly, a QR code that you can scan, and you would be able to type in your questions, and then he would be able to respond to them as we proceed. Do we have that? Yes, there it is. So you can just pick out your phones now and just scan that QR code, and then later you'll be able to share your questions. Tilewa, please. Please, another round of applause for him as he comes.
No, I'm not. I have my presentation. Let me just comment on his presentation. Okay. Good afternoon, distinguished ladies and gentlemen. I would first like to extend my thanks and appreciation to the management of Cordros for inviting me to analyze this excellent presentation that was just been given to us by Mr. Charles Robertson. And also, I would like to thank the speaker before, the keynote speaker, Elias, for his insights into wealth management. I was quite captivated by the data you've given on the transfer of wealth, of course, to the next generation, and talking about financial planning and the dynamics of wealth management, I think without a doubt is very important. You talked about wealth creation, and you talked about the wealth management, and of course the wealth ownership. I think these are three very important issues, and of course you touched on the emerging importance of bitcoins and digital cryptocurrencies in diversifying our assets in terms of wealth management. Having said that, I think the presentation, has opened up quite a lot. I was lucky to get an advanced copy of that slide presentation. And what struck me, I think, with that presentation is the fact that we need to start asking ourselves the question in Nigeria today is that, is our population becoming an asset or a liability? Because if we cannot manage a 200 million population properly, then clearly a population that has low purchasing power, I think, becomes a liability. And it's not an accident that peak milk is sold in sachets, and even Chelsea dry gin is also, alcohol is sold in sachets in Nigeria. It shows you that the basic tin of milk is beyond the purchasing power of 133 million Nigerians who are in multidimensional poverty. So the question we're now talking about, if we talk about wealth management, how much wealth are we really managing? And I think what he says very significantly, which I'll come to his presentation, as to what comes to mind, is how much wealth do we really have in Nigeria? We find out a situation whereby, if you look at some of the NDIC figures, how many accounts in Nigeria actually have 100,000 naira in those accounts? So, and what is the level of financial inclusion? 50% of the Nigerian economy is in the informal sector. And the informal sector contributes to 50% of our GDP. Unfortunately, our GDP has declined from a high of about close to $600-700 million in 2013-14, currently to about $300 billion. So that output, as you're seeing, is that how much do we really have in Nigeria to go around? And that, for me, becomes a significant question that we need to ask ourselves, especially for those of us who operate in the economy. Now, this 50% of the economy, which is in the informal sector and contributes to 50% of our GDP, whatever the numbers are today, is probably worth about 150 to 200 billion. Now, the central bank says that it has about 3.7 trillion naira in circulation outside the banking system, outside the vault of banks that are not in its control. Now, this is a lot of money, and you wonder, why is this money not in the banks and why is it not in the system? Despite the fact that we say we have digital technology, we have fintechs and things like that, because you have a large informal sector. So whatever wealth we're managing in this country, it's clear that we're not even managing 50% of that wealth. Then we want to talk about the banking sector itself. What is the level of financial inclusion, and how many bank accounts do we have in Nigeria? Maybe we have about 40 million, 50 million bank accounts, but a lot of us have more than one bank account. So our level of financial inclusion is also a challenge. So the fact is that a significant portion of the wealth of this country is not being captured. And I think it reflects in a lot of things that we're doing. Now, I want to go to talk about the presentation that we saw, which was an excellent presentation, by the way, by Mr. Charles Robertson. One of the things that Mr. Robertson has done is to focus on three key areas. He talks about education, electricity, and he looks at that, and he looks at the relationship, electricity, education, and population, and how those indices have a strong relationship or a high correlation with the level of the development of our economy. And as we have seen, if you take a look at those numbers, they're quite startling. And I think it's now time for us to begin to focus on our population. You saw the disparity of education in Nigeria when he broke it down by states. So it's not an accident that the southern part of the country is highly educated than the north. So Nigeria is always about potential. And what struck me is the fact that if you take a look at his own perspective, he was quite focused on his perspective as an investor in emerging markets. And he kept telling you that he's looking for dollar weakness, but he hasn't seen the dollar weakness yet, and he's taking a look at that in emergency. But one of the key pointers he said is the fact that all these indices do not apply if you had a current account surplus. So when you take a look at their own perspective as to how they want to invest in our country, they have told us exactly what they want to do when they want to come into our country and what is important for them here. And their numbers are very clear. If the dollar goes to a particular point, then it's a good time to come into emerging markets. So the question is, and more importantly, he looked at the Nigerian market and he says very clearly that he doesn't have a position or hasn't taken any equity stake in the Nigerian equity markets. That says a lot in the sense that they don't have that confidence, or he, from his own analysis, does not have that confidence to come into the Nigerian markets. Having said that, I think the biggest problem we have to date in Nigeria is our fiscal management, and that is what is dragging us down. The government, for those who understand my own crusade in Nigeria, my crusade has been that of the ways and means. I was quite disturbed that for a number of years in this country, the government was able to print 30 trillion in ways and means financing, and nobody said anything. We just accepted it. And ways and means financing is in direct violation of Section 38 of the CBN Act. Now, when you print 30 trillion naira worth of, when you print 30 trillion worth of naira in ways and means, the inflation levels we have in Nigeria, we're very lucky that inflation is still at 35%. Our money supply has hit an all high of 100 trillion naira. So how do you manage an economy in an unstable environment, and how do you grow? So that is one thing aside that we've done. Now we're trying to manage this scenario, and if you take a look at the financial institutions, I think they've been able to manage better than most in the sense that they're able to hedge their risks. And it talks about creating value in the whole chain. Now, when it talks about current account, because the presentation for me was very focused, because they know the right time at which they will come into this Nigerian economy. Because when they see that dollar weakness and they see a Trump coming in and they understand what Trump will do, they can understand that that will begin to signal that. Now, how are we reacting in Nigeria to a lot of all these issues? And that has been the problem. Who can remember that during the financial crisis, global financial crisis, we had $25 billion in excess crude account, and our foreign reserves were close to 70 billion. This is Nigeria, not Ghana or Dubai or any other country. This was in Nigeria. Now, it was that prudent fiscal management that saw us through that global financial crisis and saw our economy grow at over 8% to 12% at a point in time. At that point in time also, we kept inflation between 9 and 11%, and interest rates at MPR levels were between 13 and 15%. Nigeria, not another country. So why have we not been able to manage our country consistently over this period of time? Norway has a sovereign wealth fund. Last year, the Norwegian sovereign wealth fund returned $250 billion in profits for the Norwegian government. and has a sovereign wealth fund valued at $1.2 trillion. Can someone tell me the population of Norway? Does anybody know the population of Norway? Anybody? Lagos is bigger than Norway. The Norwegian population is less than 10 million. Maybe somebody can Google it and please let me know. But that is clearly that the population of Lagos is definitely exceeds that of Norway. So other oil-producing countries, Saudi Arabia, UAE, have set up sovereign wealth funds. At the point in time when we want to set up a sovereign wealth fund in Nigeria, two governors, and I tell them when I see them, Fashola and Amechi, are the biggest problems of Nigeria today. They said that excess crude oil and everything they must share and pay it down to the subnationals instead of saving it. And it was Obasanjo who started this excess crude account with an idea of fiscal responsibility. Let's keep this up. And when we got the Debt Act, does anybody know that we actually have an office in Nigeria called the Fiscal Responsibility Commission? It's an agency of government that is supposed to manage fiscal responsibility of government. That was part of the Fiscal Responsibility Act. So Nigeria, we have today violated all the tenets of the Fiscal Responsibility Act, and we violated Section 38 of the CBN Act. And we have a crisis on our hands of phenomenal magnitude. So we've come from a stage whereby instead of us to have set up a sovereign wealth fund was set up eventually, and it has a feature which they call the stabilization fund to help the government manage their deficits. Unfortunately, that fund has less than $100 million in it today. So for me, Nigeria, everything that we've done to ourselves is self-inflicted. In terms of managing our economy, especially over the last 8-9 years, more within the Buhari administration. The irony is that this same government, in their first 7 months, also drew down on about 7 trillion ways and means to take it from 23 trillion to 30 trillion, where it currently stands. And they securitized it illegally, which is also a challenge. What does that mean for the rest of us and for wealth creation, which is what we're talking about today, in terms of wrapping up? What that means from the presentation you've seen is the fact that while we have all the necessary components to make Nigerian economy a strong economy with value, we have consistently followed the path of fiscal recklessness, bad policy implementation to be able to destroy value in our economy because we've had bad leadership with economic management. What are the consequences for the rest of us? We've seen what has happened with the NGX. I believe the leadership of the NGX is here. What has been the interest for foreign portfolios? We're destroying value. And with a high inflation environment, when real interest rates are negative, as the presentation said, it's difficult for you to flow capital into that. And one advantage we had in Nigeria with oil to keep our current accounts in a surplus position, we have not really utilized it because of bad fiscal management. So we're all struggling. So how do you preserve wealth in this kind of environment? Because we create wealth. We have good professional managers. We have many banks. The professional management in the financial sector in Nigeria is world class. Everybody, most people in the financial industry are very well qualified. Accountants, lawyers, engineers, MBAs, CFAs. Good quality people have had education both in Nigeria and abroad. And we spend a lot of money training our staff, not only in Nigeria, but also abroad. So we now faced with this problem. So, ladies and gentlemen, the challenge I have in Nigeria today is how do we begin to preserve wealth? How do you survive a situation whereby in May of last year, the currency was trading officially at 460 and today it's trading at 1,600. In which economy does this happen? But yet, we're still standing. No wonder they talk about the resilience of Nigerians. But we all know what we do when we get back to our offices and we begin to do our strategy sessions. So I think while we might look at it here, I think I would like to thank Mr. Robertson for his presentation, because when you hear presentations from different perspectives, and especially his book, which he wrote, he has looked at development that we are not going to develop, we are not going to industrialize. It's clear to us why we are not going to industrialize. He talked about power. I visited the Dangote refinery. Dangote generates 1,500 megawatts of electricity by himself to run all his operations in Nigeria. He's independent of the Nigerian grid. That is why he can industrialize, because he's power sufficient. So just to reinforce a lot of what this gentleman has said, the rest of us have to struggle with the grid. So Dangote is getting gas for all his power plants. The refinery complex itself is run by a 500 megawatt electricity plant. So I'm trying to reinforce that presentation. We've talked about the sachet economy in terms of our population. We've talked about the savings. Look at the savings rate in Nigeria, what the bank deposits are like. And to make it worse, the CRR is what? 45%. So even though you get your deposits, you work hard to get those deposits, half of those deposits are not available to you for lending. So we need to look and understand the challenges, just as Mr. Robertson has. Say, how do we operate in the Nigerian environment? And the key for us is to diversify our portfolios, diversify our income streams. And of course, it's important that we need to begin to look at foreign assets. Maybe the government should allow us to invest more in Eurobonds, foreign currencies, which banks have done and which they've been taxed, because most of the banks are now being taxed for the foreign exchange revaluations, because it seems that the banks have been smart about making sure they keep some of their portfolios offshore, and when they do the revaluation, it becomes a windfall profit for them. And I think that is something that we all need to learn from, because if we do not learn from that, we begin to see something that's quite significant, because the rate at which inflation is going in this country, we can't understand. You all have staff, and I think even at whatever level you might be, look at the cost of importing vehicles into Nigeria now. The standard Toyota Corolla, I understand, is a 50 million naira car. A car which was selling at maybe 3-4 million naira at a point, and was the standard marketing vehicle for all banks. Not to talk about Kias and all the rest of the other cars. So there are challenges we're facing, and we have to find ways to mitigate them. So wealth management is about preservation of value in the long term, as Elias has said from his presentation. How do you preserve that value and take it from generation to generation? I think the great example is by Berkshire Hathaway and Warren Buffett. Warren Buffett, is a value investor, and we need to look at that, how we can constantly retain value in Nigeria. Thank you very much.
Presentation. I can see the questions are not necessarily economy-centric, but I think the third one is, so perhaps you can comment on that first. The former presenter mentions a default if we continue to lack fiscal discipline. It is clear that we cannot do austerity well. What is the probability, I imagine, of default? That's the question. What's your view?
Okay, thank you very much. Let me give you some of the data. From the Nigerian Bureau of Statistics, or from the Budget Office, this year, our finance costs and debt servicing repayment is 8.4 trillion naira. Our budget for education is 2.1 trillion naira, and our budget for defense is maybe 2.1 or 2 point something, about 2 trillion anyway. So you can see that our education, our debt repayment is 4 times that of education. So that is what we're doing. Now, 90% of our revenues are going towards debt service. The finance minister recently said that this has come down to about 70. Our revenues is about 15 trillion naira, which is about $10 billion. Dangote revenues next year is going to be about $30 billion from refinery and all his group. So Dangote's revenue is now going to be 3 times that of the Nigerian government's revenue. So what we're facing is a critical issue. We have 2 or 3 budgets, which is like significant fiscal indiscipline. So this year, the budget deficit was 9.5 trillion. Now they're doing a budget of 6.2 trillion. And we now had a shortfall of about 3.5 trillion from the initial budget. So the deficit to take us from now to the end of the year is 19 trillion naira that the government is looking for now. So that's why they've gone for the windfall tax. That's why I'm looking at you. So to try to fund some of that. So
but what's the probability of default, though, in your view, given this scenario you've painted?
Well, the probability of default depends on how the government manages its fiscal issues. If they manage it well, there shouldn't be a problem. If they don't manage it well, then we'll go that way. So the default probability is based on how government manages its fiscal space.
Thank you very much for depressing all of us today with your presentation, sir. Please, a round of applause for Mr. Adebajo.
Thank you.
I was just humorously saying that you succeeded in depressing us.
No, it's not me.
But Nigeria, we are.
I'm just the messenger.
I'm
just the messenger.
Well, message taken. We have a lot to think about. Thank you very much again. Please, another round of applause for him. I must apologize because of the pressures of time. We're unable to take more questions. But I believe that we've gotten the message. Tough times. But I can assure you that there's still a lot more positive news coming out of today's event. But a lot to think about. So it's really frank talk. So now we're going to take a presentation from Mrs. Linda Quino. She's a senior partner at Vercam Capital, and she will be giving us some very useful perspective on the subject today about the wealth revolution. So if we can have Linda on. She's joining us virtually as well. It's a short one, and then we're going to move on to a panel conversation.
First of all, congratulate Wale and his team for organizing such an insightful Cordros Wealth Summit. I'm excited to be a part of it. But secondly, I'd like to apologize for not being there in person due to the protest that is happening on the 1st of August. I was not able to join because I have some pressing matters that I have to address in Ghana. I have known Wale for a number of years when I was a partner at Deloitte, and I know him to be a disruptor, very innovative, and very ambitious in terms of what Wale wants to do in the Nigerian market. And so when he asked me to participate in this summit, I was really very excited, really to share what we are doing at Vercam Capital, and specifically around the real estate space, which is what the Cordros team have asked me to speak about. I'll just take a minute to briefly talk about Vercam Capital. We are fully women-owned, women-led investment advisory firm. Our work is Pan-African. My partner is Nana Piakrang, who has over 25 years private equity experience across different markets. And jointly, we have an audacious ambition to really work with institutional investors, insurance companies, pension funds, particularly focusing on infrastructure in the real estate space. Our focus is to help our clients with their investment solutions, provide financial advisory, and focus on impact investing. So now back to the conversation around real estate. I'm sure a lot of people in the room are wondering, why are we talking about real estate? Most of you in the room are seasoned investors in the real estate space in one way or the other. Real estate is not a new asset class in Nigeria. A lot of you have been investing directly or indirectly in commercial properties, either offices, mixed-use properties that are anchored by retail malls, or in some cases, housing properties, luxury and affordable housing. But these have mostly been greenfield developments, where the issues on land titling, zoning, cost overruns, and occupancy rates are high risks that are not fully mitigated. Other challenges have included liquidity exits, and this has hindered Nigerian investors from fully optimizing their investment return. So what then is new? What is new? What are we seeing on the market? I'll share with you what we are seeing in some of the transactions that we are talking about. But a lot of these are focusing on aggregating income-generating real estate assets into real estate funds or real estate investment trusts in an area of growing opportunities across select African markets, including Nigeria, Ghana, Kenya, Zambia, and Ethiopia. Why those markets? Primarily because those markets have matured through the development of their real estate assets and now have scale in terms of income generating assets. By aggregating these income generating assets into secondary funds or REITs, it creates new forms of real estate investments for your portfolios, essentially attractive risk-adjusted returns for investors. Let me use two examples to illustrate what I'm talking about. I am sure a lot of you in the room have heard about Lango Real Estate, and for full disclosure, I do not work for them. They are formerly known as Growth Point Investec African Properties and were launched in 2018. Lango means entry point or gateway in Swahili, and it reflects Lango's strategy to become an entry point for sophisticated investor capital to flow into the real estate sector in Africa and to invest in key gateway cities in which Lango focuses on, such as Lagos, Accra, and Lusaka. Lango has acquired a quality portfolio of commercial real estate assets to attain meaningful scale in relevance in the sector. They have emerged as a leader in the African commercial real estate market, but this excludes South Africa. Lango owns and manages a quality portfolio of income-producing real estate assets, including several prime office and retail properties in Accra and Lusaka, and the total assets under management is over 600 million. Lango plans an IPO in the next few years and because it has established a track record in concluding successful and accretive transactions and has added further growth to asset value post-acquisition, it is an exciting fund to watch. Lango has also had a very, very good track record of paying distributions to shareholders. They also particularly focus on the efficiency of their capital structure, as well as other initiatives that they have undertaken to enhance the operational efficiency and the returns of the business. My advice would be Nigerian investors can participate in the Lango Real Estate Fund when they raise further funds or when they have an IPO potentially on the Nigerian Stock Exchange, Johannesburg Stock Exchange, or the London Stock Exchange, or potentially some joint listing on either of these two exchanges. Next, let me quickly talk briefly about a project that is dear to my heart. It's a Pan-African real estate innovative transaction which Verkan Capital has been advising on. Our client is a US-based Vedant Ventures, and we've been supporting them in fundraising for a new real estate asset class. And this asset class is particularly in diplomatic housing, specifically for the US government in emerging markets. Vedant Ventures, which was established 7 years ago, their proposition is based on the unique opportunity to build high security housing leased by the US government in Africa. To date, Vedant Ventures have built and fully leased 2 properties in Nairobi and Addis Ababa to both the UK and US government. They are also on track to build a 3rd in Ghana, and this is the particular transaction that we are advising them on. But essentially, they have shown a track record of delivering on budget and on time, and they are also exploring inorganic growth to de-risk their strategy, increase liquidity options, and create greater long-term value and impact in this sector. Now, the long-term US-denominated lease agreements between Vedant Ventures and the US government is really the game changer. You have no currency depreciation. You have strong financial counterpart in the US government. You have long-term leases and very attractive lease payments. This creates an attractive risk-adjusted offering with superior returns. What we are seeing is potential equity IRRs in the 20% range. I hope these examples really reflect some of the opportunities that we are seeing in the market, and these would be of interest to you. I'm excited that Wale and team are keen to work with Verkan Capital to really co-create solutions for the Nigerian market that we can really bring to investors as yourself. Wale, thank you very much for inviting me. I look forward to further deliberations and participating in the summit, although I'll be doing so virtually from Accra. Thank you again.
Diverse viewpoint, and we'll be having our speakers do justice to that when we kick that off in a few minutes. But before that, I would like to invite to the stage to deliver a short presentation on representing Mont Blanc. I think they have something interesting to share. Just a moment, please. I'm just trying to get my information right here. Right, so we're going to have an introduction to Mont Blanc, and doing that will be Imalbong Obot. So Imalbong, if you can please step forward to deliver your presentation real quick. Imalbong here? Okay, please, a round of applause for her as she comes forward.
Good afternoon, everyone. Thank you so much for this opportunity. I must say the conversations have been extremely insightful, and it's a pleasure to be here. My name is Ima Bong, and I work in business development for a company called Polo. We're an indigenously owned company. We've been around for, about 37 years. And we basically One of our strengths is we're authorized dealers for over 35 renowned luxury companies in the world. Over the course of today, we've spoken about various things, including the importance of wealth management, cryptocurrency. The keynote speakers spoke about a subject I really like, which is the importance of women and the future of business. I'm here to basically talk about luxury as a reward of success. Success, as we know, excuse me. Okay. Yes. Success, as we know, is more than just an indulgence, or luxury, as we know, is more than an indulgence. After successful financial years, profit sharing, dividend earning, it's very important that we reward ourselves, our partners, our sponsors. Luxury is often seen as an indulgence, which is right. However, in reality, it is more than that. It represents a tangible acknowledgement of success and a benchmark of personal and professional milestones. When you invest in luxury, you're merely investing in an item. However, you're acquiring craftsmanship, heritage, and more than a piece of art. One of the most compelling examples in investing in luxury is, I would say, timepieces. These timepieces are more than just investment pieces or instruments that tell time. However, it's an embodiment of precision, engineering, and design. I represent a company who carries business brands including Rolex's Cartier, Audemars Piguet, Piaget, Patek Philippe, Montblanc, etc. And one thing that these brands are known to have are more than just a luxury piece, but a more storage of value and investment of value. Beyond the aesthetics, beyond the status symbol, beyond the value, beyond the luxury pieces, these instruments are substantial, and historically, they have appreciated in value over time. Just like other traditional instruments, such as stocks and real estate, I say that luxury pieces fall into investment values, or at least storage of value. The limited production, the high demand, and the timeless appeal ensures that certain models become more than coveted and valuable pieces. Brands like Rolex, like earlier stated, brands like Patek Philippe, Montblanc, have set a gold standard for luxury in the industry. And having owned one of these pieces are synonymous to prestige and distinction. Beyond the financial aspects, the benefits of investing in luxury watches, timepieces, writing instruments, etc., are manifold. They offer a sense of accomplishment and a daily reminder of the hard work and dedication that we put into our work and effort. Wearing a luxury timepiece or representing a luxury timepiece is a personal statement. If you were gifting it to someone, it represents the sentiment, or it represents the value that you place on a person. And it's also a reflection of your taste and a marker of the achievements that you've done over the period of time. In a time like this, it's a versatile accessory that complements your style, whether in business meeting or a social gathering. It enhances your confidence and your presence as well. The luxury as a reward of success is not just about indulgence. I would say it's making an informed decision, a strategic decision to honor either your partners, your sponsors, your employees at a time, the beginning of a milestone, the end of a milestone. It also helps to provide potential financial returns, I would say. Luxury timepieces optimizes the balance perfectly. And they're timeless pieces that celebrate your journey in enhancing your personal brand and your business brands as well. It serves as a prudent investment to ensure that your storage of value works. Investing in luxury pieces in 2024 is definitely a good idea, and it comes with several considerations. One, it has an appreciation potential. Brands like Rolex, Patek, Audemars Piguet often appreciate in value. This means that you can purchase at a certain price, and there's a return on investment over a period of time as well. It has a market dynamic due to the scarcity and exclusivity of the product. With all of this, I'm just here to basically introduce our brand. We Polo, we've been around for 37 years. We have carried these brands over this course of times, and we have existing relationship with these businesses for over 20 decades. And with us, we're trusted, we're convenient, we're at your beck and call. And over the course of the time, we have some exhibition or some products over the other side of the room, which we can basically discuss and showcase more in your time. Thank you so much for the opportunity. I'm deeply grateful.
Thank you very much, Malbong, for that presentation. Hopefully, information you can use, and please do your best to connect with her right after this. So we've had to shift things around a little bit because of some scheduling issues with some of our speakers. So what we want to do now is to go straight into the panel conversation. So I'm going to invite the moderator, and she will introduce the panelists, and we'll get right into it. And this time, I can assure you, you will have the opportunity to ask more questions. So please put your hands together for Rolake Filani. Yes, Rolake Akinkugbe Filani is General Manager, Investor Relations and Corporate Development at Zenith Bank. And she does a lot more. I'm sure you all know her on Arise Television. So she's very, very qualified to do this. I'll hand over to her now as she introduces her panelists.
Thank you very much, Wally. Good afternoon, ladies and gentlemen. It's a real honor to be moderating this panel. We've heard a lot since the morning. We've been talking about... Okay, all right. Okay, I've been told to move. Right, so we've been hearing a lot this morning about sovereign wealth. Now we're going to be talking about private wealth. And I guess in the context of everything we've heard, you're all probably wondering what's the point of managing private wealth. But to help us get through this discussion today, I'm going to invite our panelists. First up, I'd like to invite Abiola Adediran. She's a partner at the Genia Family Office with a focus on family business. Please give her a warm welcome as she comes on stage. Thank you. And we also have Doyinsola Ola, Head of Private Wealth at Cordros Asset Management Limited. A warm round of applause for her as she comes. Joining us virtually, it's a hybrid panel, you heard her speak earlier, is Linda Kano, CEO of Verkan Capital. And last but by no means least is the only gentleman on this panel. It's none other than Bolaho Aino, Managing Director, Cordros Asset Management Limited. Please give him a round of applause as he comes on. Thank you. So can we just do a tech check to make sure Linda is with us? Maybe we can get a visual of her on stage. Okay. All right, so one of the very first rules of investing from the great Warren Buffett, we heard him referred to by Mr. Adebajo earlier, was that the rule number one of investing is that you never lose money. Seems like a very basic principle, but we have these experts here today to talk us through. And so the question really is, what is the scope and benefit and extent of the wealth management industry? The entire asset management industry today in Nigeria is meant to be the second largest in sub-Saharan Africa after South Africa. There's meant to be, at least as of the 2023 count, I think somewhere like $7.8 billion in assets under management. And much of that is also hosted within the family and generational wealth context. So one of the things we want to set out today is to help people understand what the emerging trends are, some of the economic impact that we see in that segment, what the opportunities are for shoring up and preserving wealth over generations, what the approach and attitude of the younger generation, the Gen Z and the millennials, versus the baby boomers and the older generation are towards wealth, and also really just helping us understand how we manage risk in the context of wealth creation. So the very first question I'm going to pose out today really is to Doyinsola. We talk about the wealth management industry in Nigeria, and we often talk about a specific demographic of people called the ultra high net worth individuals. You know, every time I personally hear this term, I think of the 1% of the 1% of the 1%. So can you help us understand who really are these people? And can you then quantify, maybe in monetary terms, what it means to be an ultra high net worth individual? Thank you.
All right. Good afternoon, everyone. And thank you for the question. So by definition, the UHNI market in Nigeria currently is a unique and niche segment, which is characterized by a high level of privacy, which makes it really difficult to really ascertain the numbers of people that are currently UHNI in the country. And that's also because of the confidentiality nature that surrounds the sector. That said, there are several reports, unconfirmed, that gives a value of about 3,000 to 4,000 people currently in Nigeria. But then there's an Agosto report in 2022 that mentioned that the assets under management currently in Nigeria, as of that time, is about 3.5 trillion, which validates the fact that a lot of funds is in the sector. It's a and the wealth management sector is also growing. So for you to qualify as a UHNI, we're looking at assets in excess of about $30 million. This qualifies you as a UHNI, but that's not catered to only UHNIs. We cater to HNIs, emerging HNIs, and the likes. Thank you.
Sure, thank you very much. That was very useful to understand. I mean, when you think about a figure like 3,000 Nigerians versus 220 million Nigerians, that's clearly a very niche market. So can I also then ask you, given the current macroeconomic environment, the impact of high inflation, some of those figures you're quoting in dollars and some of the wealth that resides within these, this really wealthy class, we've seen a lot of erosion of value. How has that impacted the work you do in managing that particular demographic? Can we do a mic check, please? I don't think she's audible.
Hello? Okay. So without a doubt, inflation poses a significant risk to wealth erosion if it's not properly managed. However, adopting some management strategies can reduce this, that's inflation. Wealth management strategies like diversification. Sorry. Okay, so I'll take that again. Adopting strategies like diversification, investing in growing assets, and also regularly balancing your portfolios can help reduce the impact of this effect. And also, reduce the impact of inflation, which adapts to the changing environment. So if you employ these strategies over time, you tend to mitigate against inflation, thereby ensuring the long-term sustainability of wealth and also preservation of wealth. Thank you.
Thank you very much. I see we have a second mic coming to keep the dynamic going. So I'm going to come to you, Bolaho. In the context of what you do as the managing director of the asset management of Cordros and as an investment specialist, what specific economic dynamics, we talked about inflation, are shaping the way you're running or operating your business today? Can you help us understand what some of the specific impact of the current environment is on the business?
Okay, thank you, Rola. Okay. Can everybody hear me? Okay, thank you. That's a very good question. So I think the economy is faced with sort of a confluence of issues or factors. Globally, really, the economy has been resilient coming to 2024, faced with a tightening environment. Most global central banks have been tightening, and due to the high inflation that we've experienced. Also, the weakness in growth in China as well has affected the global economy as well. But if you look at the global economy, it's been resilient. The job market has been robust. Also, we are seeing pandemic savings also being depleted as well. We are seeing geopolitical tension. So there's Israel, there is Ukraine and Russia. So all these affect the global economy. That being said, we've seen a bit of resilience in the global economy. Now coming to Nigeria, the key factors are exchange rates. I think that has always been an issue with Nigeria. Inflation as well. Inflation is over 30%. And of course, the CBN has maintained a tightening policy. That has affected how people invested. As of last year, in terms of exchange rates, we're talking about less than 1,000, about 900. And I know when it was at 900, everybody thought, oh, it can never go worse than that. Today, we are like 1.6. And so that is affecting the way we do business. But it's also been positive. I think the way investment is either side of the coin, you can always make money, good times or bad times. So we've seen the CBN have a restrictive or a tightening policy as well. We are seeing treasury bill yields almost touching 30%. And we're seeing a lot of our clients showing interest in those high-yielding instruments. We have some mutual fund as well. We're seeing clients show interest in the money market mutual fund. This time last year, 2 years ago, there was a lot of interest in dollar products. But everybody thinks dollar is cheap now. So people are on the sideline. Even though there has been some depreciation, people still think that there's a potential that Naira might appreciate, maybe in the medium to short term. Long term, I think everybody still think, oh, I'm long dollar. But the short term, people still think there's a level of appreciation. And so it has really shaped the way investors are reacting to the market. We are seeing more of people moving from equity market to fixed income products, moving from real estate to fixed income products. And we still see some people preserving their funds in dollars, so those that have obligations in dollars as well. And I think it's not just Cordros, it's sort of just affecting the whole industry.
Sure, thank you very much. And just as a quick follow-up question on that, I mean, you said a lot about the macroeconomy, which I think many of us are very familiar with. But looking at the strategy around how investors make decisions, many of those trends you point to appear to be things that drive short-term decision making. So you talked about capital flows into T-bills, for instance, due to the high rate environment. What are some of the longer-term popular asset classes that you're seeing within some of the portfolios that you're managing that are not necessarily swayed by the short-term economic dynamics within the country?
Yeah, thank you. So couple of them. So we have short-term investors and we have investors that think for the long term. So for most people that are long term, they're usually long dollar. So dollar has been sort of a currency and asset that has been stable over time. And so most of our clients have strong bureau bond positions. They also do some dollar placement as well. There are dollar mutual funds as well. So from a long-term perspective, they are long dollar. However, we are seeing some renewed interest in real estate, dollar type of real estate. We are seeing interest in commodity, especially gold, as well from some of our clients. So there's a lot of interest in alternative assets. So that gives you an inflation edge. And that sort of also gives you a premium for what the traditional assets are doing. So people are long dollar, and we are seeing a lot of interest in alternative assets like gold, commodities, at the moment. Well, so crypto, so for the younger generation, right, so they love to explore crypto, but for the older ones, the old money, they are comfortable with their real estate, they are comfortable with their money market product. But since crypto is not something that we offer as a product as well, so it's not something that we push, but what we just do is from an advisory perspective, from an information perspective as well, we're able to guide them or just provide information here.
And I guess one of the reasons I sort of prompted with crypto, I know in the last few years, there's been a lot of activity in that market, and it still seems to be a very popular investment class, especially in overseas markets. I know there's been a lot of regulatory clampdown within the market, but also that's driven by demographic trends. And I want to come to you, Abiola, to maybe talk about family businesses and family offices. In many countries around the world, you have really sophisticated family offices that are doing everything from private equity investing to venture capital to real estate. Can you tell us about some of the trends defining the family business and the family office in the current market? Thank you very much for that question. When you think about the family offices, in Nigeria, for instance, it's still very much at a very nascent stage because you don't find a lot of them. There are very few single family offices, which is really focused on one family, right? And they were beginning to see a lot more multi-family offices, that serve multiple families, which is where we play, right? So if you think that the UHNI market is niche, so the family office industry is actually very, very niche. And, from my experience of working with clients in this space, we're seeing a lot of, changes to the investment strategy because, of course, the economy is moving, right? Things are really very dynamic. And I think more importantly is the fact that, based on a lot of research and, news and things in the internet, you hear a lot about the wealth transfer, that is going to be happening within the decade or, 2 decades from now. And if you look at most of the oligarchs, even in Nigeria, you'll find that a lot of them are in their 50s, 60s, 70s. Many of them will be retiring over the next 1 or 2 decades, right? So there is that shift, that generational shift, where a lot of G2 are now coming to the scene. A lot of their next
G2?
Generation 2.
Okay. Okay. So I think I'm going to come back to Doinsola. And I want to talk more maybe around the multi-asset portfolios and single asset portfolios. There are some asset classes which have traditionally been much, much safer. How is the trend shifting now in terms of the overall portfolio management? In Nigeria, first of all, and then maybe globally, what is the most popular single asset portfolio class? Apologies if that sounds like a jam question. And then if people are diversifying away from that rapidly, when did that diversification really start and what is driving it today? Thank you.
All right, so thank you for the question. I think based on experience and given the current realities in the market, a lot of the clients and prospects currently are tilting towards single asset portfolios. And this is because by engagement, the first thing they say to you is, if I give you X amount of money, what interest rate are you giving me? Or, oh, Treasury bills is high, I want to invest in Treasury bills. So what we do differently is we educate them to let them understand the benefit of multi-asset investment and also diversification, portfolio management, and over time, it's quite a difficult sell because they're already fixated on, I want a certain interest rate, and the majority of the asset class they are exposed to is fixed income securities. So bringing conversations around diverse asset classes takes a while for them to sit into this kind of conversations and understand the process, eventually allowing you manage the portfolios effectively. The developed world, because they are more informed and more exposed, a lot of the portfolio management is strictly multi-asset investment and portfolios, having different asset classes, a mixture of fixed income securities, equities, alternative assets, commodities, and the likes. But here in Nigeria, and what we're trying to also do differently, especially where we're engaging clients, is to see them through the financial planning journey, see them through the conversation on a need-based conversation as to what their investment can do for them and how their investment can actually work for them as against going into investing in single asset portfolios. And that's also because with single asset portfolios, it has its own risk of reinvestment and the like. So these are the things we put them through to understand so that they are in a better financial position. Thank you.
Okay, thank you very much. I see that we have Linda back on. Linda, can I just check that you can hear me?
Hello, can you hear me? Hello? Hi there, can you hear me? Hello? Hello, can you hear me? Can you confirm if you can hear me, please? Okay, great, but I can't hear Rolake. I wonder if it's possible to drop the questions in the chat and then I can respond to them. Hello? 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 Hi there. Okay.
A lot of the corporates that are issuing commercial paper, not all of them might be able to pay back. So you need to be very sure what is the investment rating on these instruments, what is their track record, how many insurances have they had in the past, have they always paid, their CPs, what does their financial look like as well. So I'll sort of stop there. So liquidity risk, market risk, and default risk are some critical things that investors should look at.
Thank you. Thank you for that, I guess, laundry list of risks to look out for. There's one risk in particular that I think is something we should talk about, and I wanted to give you a heads up, and it's succession risk and people risk, insofar as families are concerned, because we've heard so many stories, but maybe I can just park that and go to Linda and ask her the question I posed earlier. Linda, so my question was around real estate assets, real estate investment trusts, versus returns on different types of real estate assets, such as commercial, residential, hospitality. What are the pros and cons, and what trends are you seeing in that space? Linda, over to you.
Thank you. Like a pleasure to be here. Confirm if you can hear me. I will carry on talking, assuming you can hear me. So in a lot of the work that we've done, traditionally what we are seeing is investments such as gold and real estate tend to be preferred as a good hedge against inflation. Properties in markets historically outpace inflation. Underdeveloped land is often considered a robust inflation hedge due to its tangible nature and limited supply. And what we're seeing is that these principles are expected to apply to developed properties in general. Notwithstanding, fixed income securities during this period of high interest rates are attractive, especially if the interest rate is fixed. Yes, if the interest rate is fixed. However, it is important to pay attention to the macroeconomic trends, as central banks will not forever raise interest rates to counter inflation, given the adverse contradictory impact on private sector and economic growth. So for us, it's really about portfolio diversification and appropriate allocation of funds to various risk asset classes. In terms of returns, let me just quickly point a number of things. Commercial properties, the returns tend to be quite high. We see equity IRRs for greenfield commercial properties in the north of about 30%. Equity IRRs for income generating properties are in about the 20% range. But these are all impacted whether the developments are made for sale or rentals as they get. These are also market dependent.
The Nigerian context is evolving. You know, over the years, we've had a lot of education on this. In advanced markets, you hear about families, businesses that have become major global multinationals that have lasted for 200 years, 300 years. So can you tell us what the current trends in the Nigerian market are? And also perhaps talk a bit about situations that have arisen that have actually affected the ability of a family to sustain generational wealth. Now, you don't have to give specific names, but what sort of lessons are you learning about how families can do better in terms of succession planning?
Thank you very much. I'm a very, very big proponent of early succession planning, and the reason is simple. When I did a study to look at, companies around the world that have lasted for over 100 years, even 50 years, you find that you rarely can put your hand to an African business, right? And I began to probe to understand why is this the case. I think that, it's something with our culture, right, that makes us want to build our businesses around us and just keep it within the family. Now, while we're seeing a bit of changes with that because there's been a lot of education, and of course with the advent of family offices now working very actively with these families, there is the need, or there is that shift that is happening in terms of how people are then embracing, preparing the successors or even identifying successors to start with. Typically what you will find, in an African business is that the man runs the show, the business founder, whether it's a man or a woman, runs the show. And I think there's also a sense in which we feel like we're going to live forever. So even at 70, you find that the founder still wants to come to the office, still wants to sign the checks and all of those things. But we're seeing a lot of that changing in recent times, right, with a lot more education. And they're beginning to sort of, identify the fact that, they have to take early action with naming successors or identifying successors and grooming them, because it's not just about identifying them, it's about the education that they need. Sometimes you find that the first generation or the founding generation are uncomfortable to leave the scene because they feel like the next generation are not prepared, right? And so we say, focus on the preparation so that you feel comfortable to start to let go gradually. Institute your corporate governance. We find a lot more family businesses now setting up boards, having proper management staff that is not just family members, having a lot more experts come in, right? And so with that, we're seeing a bit of changes, but I can tell you there's still a whole lot of work, right? We've seen family businesses that have pretty much packed up because there was really no succession planning, and the founder passed, and they just thought that maybe the firstborn would take over and step into the shoes. But unfortunately, the young man is like, this is not the life that I want. I have other things that I want to do, right? And I've gone abroad. I've even set myself up abroad and all. Why would I come back to run the family business? And we've seen different, examples of that, right? Where, without so much plan, right? That you have a structure in place that can step in and take care of that.
Thank you. Okay, so just very briefly, can you also talk about separating the succession planning from the actual wealth management? Because you have families who don't have successors or heir apparents. but the revenue or the dividends or the profits that's generated from the business then being plowed into a wealth management structure. It's because essentially what I hear you saying is that a family office is almost a solution to succession planning for a family business, right? A business being an operator that then generates profits or creates an endowment from money generated from that business that's then put into a fund. Are you seeing more and more Nigerian businesses transition from just having a family business to then having a fund that manages the profits that have been generated from that business?
You're very right, because the business is just one asset class, right? And so you have a family that has also invested in other asset classes. So there's a portfolio of wealth, of which the business is just one, right? And so there is need for wealth management. Right. And that is why you have family offices, coming in to manage that pool. The business is one, the entire wealth is another, right? And the business also brings income, generates income that is invested in different other asset classes, and there has to be an administrator. In the event that, the person that created the wealth is no more, right? How do you take care of the next generation? How do you plow back the returns? What do you invest in? How do you ensure that the wealth continues to grow? Apart from the business, because like I said, the business is just one, right? So we're seeing more family-owned businesses and wealth creators making that shift, right? So we're doing a lot more things around setting up trusts, so setting up asset holding vehicles, let me just put it that way, where they're putting their wealth SPVs and putting them in different jurisdictions that best suits, their objectives.
Thank you.
Yes.
Thank you very much. So we're going to go to the floor for questions. Take 3 rounds of questions. Please keep them very brief, straight to the point, and let us know who you are. Thank you. No questions? Okay, so I can proceed because I have more questions for the panel and we still have time. So I wanted to talk about technology, and I'm going to come to you doing how technology is shaping wealth management and investment trends, not just in terms of technology as an asset class, but how it's even impacting your business and how you advise your clients.
All right, thank you very much for the question. Technology is helping us in terms of advisory, and this actually helps with a trend in what the client is doing. So at the end of the day, in advising our clients, we tend to give them the best implementation of strategies. And again, they also have the opportunity to also see what is going on in their portfolio. So for conversation, they have hands-on information as to what asset class has been invested. They have access to information as to returns. And these are timely conversations that actually also shift in the advisory we give in terms of patterns that we've experienced over the time. And in creating some of these strategies as well, we also leverage on robo-advisory. Robo-advisory.
Robo?
Yeah.
Okay, can you explain that a bit more, please?
So it's like a simulation of patterns, so to speak, to generate the kind of decisions that we would implement on some certain portfolios. And that's also because there are different portfolios based on asset class, based on investment objectives and investment horizons. So all of this actually helps in decision making, and at the end of the day, help give our clients a very worthwhile experience.
Okay, thank you. That's interesting. So I want to come to you. Oops, apologies for that. I want to come to you.
I have a question.
Sure.
Thank you very much. And maybe this will also, as they say, ginger the audience.
Sure.
But I was wondering about building efficiency into a portfolio, maybe for a family office or just a wealth portfolio in general. And I'm looking at the vehicles we can use to bring in things like tax efficiency, things like trusts. I just wanted to hear your perspective on those dynamics right now.
Okay, is that directed to?
Yes, I think.
Okay.
I think she can
Tax
take
was actually going to be my next question, but I'll elaborate on that.
Yes, tax is a big issue, right? When you have substantial wealth, then your tax can be substantial as well. And so that's important for you to, plan ahead of that, just be able to estimate what your tax exposures are, and take the right steps to mitigate them, or at least to reduce your tax burden as much as possible. And so what we're seeing with a lot of families is that they want to explore different structures that provide some sort of should I say, manages their tax better. So we see them exploring structures like trusts, like foundations. They typically are, structures that provide a better, management of that exposure. We also find that a lot of our clients are interested in setting up these structures in tax havens, right? Places where their taxes are sort of minimal, right? So that's sort of what we're seeing, the trend that we're seeing. A lot of people are taking advantage of these sort of jurisdictions. Many of them are taking advantage of it in terms of multiple citizenships that allow them to be able to set up these structures, and they can access those structures because, they're citizens of those countries. So that's sort of what we're seeing.
Okay,
So
thank you.
investment in citizenship is now a thing.
It is, actually.
It helps your wealth.
Absolutely.
Okay, thank you very much, Wale. Thank you, Biola. And maybe just to segue from that, a couple of questions. And it's really around how one gets started, because it's easy in these types of conversations to assume that everybody has $2 million as your lowest threshold.
Entry point,
right? And in terms of actually starting on the journey of investing, if you look at the savings of average Nigerians, even middle-class Nigerians, we've had a lot of erosion of purchasing power. Recently, there was a stat that was released by, I think it was CBN, I'm not sure, maybe the National Bureau of Statistics, that the demand for overseas education has fallen. It's quite a significant fall in demand. What that suggests to me, for you to see a fall in demand for overseas education, it's no longer just the bottom of the pyramid. Now we're talking the disappearing middle class, which has been eroded significantly. So the question is, even getting on that wealth ladder, let's even talk Naira terms, let's even go to dollar terms, because most people really would not even be on that ladder. How do you really get started on that journey in this sort of climate? And I want you to use, let's say, a young graduate who's been in work for 4 to 5 years and is thinking that they really need to start having a wealth creation strategy, and they don't have mommy or daddy's money to inherit to start that journey. What would you advise? How would they get started?
I think that's a very, 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 very good and important question. But I think the first thing is really need to understand where you are, first off. So where am I in the wealth creation ladder? And I usually say that the journey to financial freedom or financial security starts with financial planning. So there ought to be a financial plan. And I can just sort of list some certain components of what your financial plan should look like. One, you need to understand your net worth. So what do you have? What is your value? And that's looking at your assets less your liability. That sort of gives you an idea of your net worth, and that's very important. Also, you need to understand what I'll call your X factor or X money. So that's like how many months you can survive without earning an income, which is very important. And one, do you even have an income to start with? So one, understand your net worth, understand your cash flow analysis, because oftentimes people without money coming in, in Nigeria, for instance, people have handouts. You'll be surprised how much people make on a monthly basis, maybe from uncles, from cousins. So you need to understand your cash flow, how much comes in, how much goes out on a monthly basis. And if you are in the red, for instance, you knew that you probably need to get a job. So understand your cash flow analysis, for instance. You understand your risk profile. So if you look at the financial life cycle, for instance, people that are younger can sort of take a lot of risk. By the time you are reaching your retirement or your post-retirement, you can't take too many risks. So why are you in the financial life cycle, which is very important, which is risk profiling. And once you understand that, then I think another thing is budgeting. Even though all these things sound theoretical, really they are very, very applicable. So for my cash flow, from what comes on a monthly basis, how much am I able to commit to this financial journey? And say, for instance, you earn 2 million a year or per month, for instance. You need to be able to sort of allocate what you want to be growing, what you want to also have fruits, and not that you're eating everything, which is very important. And of course, you can also talk to a financial advisor like ourselves. So once you're allocating that money, it needs to sort of begin to earn return. And that's where understanding different sort of asset classes, what can I invest in, and there are quite a ton of it. And apart from the asset you can invest in, she mentioned some tax efficiency as well. So tax planning is also an important part of your financial plan as well. So how do you manage tax? either in terms of reducing what you're paying out in a legal way, then also estate planning as well. Even though you are not about retiring, you might not have $10 million or $30 million, you can begin your estate planning journey, for instance. You can have your RSA account, you can have a simple will, for instance, and that probably include your bank account or your RSA account. That's just you being deliberate about that financial journey. I think the most important thing is also to get education and get information. And if you sign up with any of the wealth management companies like ourselves, so there are tons of information that we send out in terms of market trend, in terms of opportunities as well. I know Zenny Bank offer is coming out. You'll be amazed how many people will want to buy that. Or yeah, I think I saw the signing ceremony. Was it yesterday? Day before yesterday. There's Access Bank. So we get clients asking all those sort of questions. Money market mutual fund, for instance. I think one thing we've also done very well in Cordros is that we used to go to schools as part of our financial literacy. So we've gone to several universities, just teaching them about this thing, about starting that financial journey early, which is also very important. Secondary schools as well. We have comic that we made, that we sort of made it in simple terms for somebody in primary school to understand these financial terms, somebody in secondary school to understand these financial terms. So I think nobody's too old or too young to start, and nobody's too poor to start. You just need to understand where you are, and now begin to sort of allocate your resources and seek information.
Excellent. So just one more closing question for the panel. I don't think we have any hands in the room, but I think that question was really important because I think it's important for these sorts of discussions to be steeped in reality. And often it's easy to sort of get carried away in the wealth revolution, realizing that there's a huge demographic of people who also need to get on that ladder. But perhaps my final question really is around the policy environment. You all run businesses as wealth managers, as investment advisors, as family office advisors. Your business and the advice you give to clients is affected by policy. What are some of the big policy catalysts that you would like to see in the Nigerian economy that you think will help you do your job better and help your clients sustain and preserve their wealth? So I'm going to start from you, Doyin. And then I'm going to go to Biola and end with Bolahon. So very briefly, one or two policy catalysts we are advising Tinubu's government today. Thank you.
Thank you very much for the question. I think before I answer that, I need to also mention that wealth management is a journey and not a destination. And again, preservation and patience is very key in getting to the final destination. And that's also because of the conversations and the way clients react to portfolio swings and movements. So in terms of policies, tax is one of the considerations, especially now that most of the fixed income securities has been taxed, which reduce the returns that eventually the client is booking in their portfolios. So if tax is reduced, it also helps us in terms of engaging clients and getting more funds from clients as against looking at other asset classes and shying away from fixed income investments that's affecting their returns. Also, capital gain tax again. So pretty much reduction in taxation so that we can have more funds from clients and do more investment with clients. And for me to close really, I'll probably still go back to the wealth management conversation, because that's the bulk of what we do. And I'll also take a cue from the first question being diversification of wealth, which is what we preach. And since we take our clients through a journey, we tend to understand what their financial situations are. And in identifying this, we also get to know what their risk appetites are and the investment horizons available for investment. So once we ascertain all of this, we then implement a plan which is also agreed by the client. So we don't just invest openly. We have a conversation with our clients and we agree on what we are investing and we monitor. The essence of this basically is for you to have peace of mind, to have financial security and freedom, and also to make sure that your investment objectives are met. And it's safe to say that we make your money work for you so that you have the peace of mind that you want. Thank you.
Thank you. It's interesting that you mentioned reduction in tax. Currently, the pendulum is swinging in the other direction, but we'll take that on board. Thank you very much, Doyinsola. Abiola, to you.
I think the tax is a big one, but I think I would focus on maybe the monetary policies that impact, the swinging naira-dollar, relationship. As you would already know, a lot of, people that we call UHNIs, right, who have a certain level of wealth, when you convert that to dollar and you see how things are moving, you see how quickly, your wealth is dissipating, in dollar terms. You can literally just see the downward trend in terms of what your net worth is from one period to another. And so what I would like to see is maybe further strengthening of the naira, by deliberate attempts of government to implement policies that can actually help us see more of that. And why this is important is also because a lot of the families that we advise, have a lot of their investments in Nigeria. So they are not going anywhere. You're not going to carry those businesses and take them somewhere else, right? Except they are going to be shutting down and starting up in another place, which is not really feasible, right? But if they see their businesses doing better in an economy like this, I think that, they would be in a position to continue to do business in Nigeria. And of course, it has implication on what their wealth can potentially also be.
Fantastic. Thank you. So the exchange rate, Dolahon, you finally, please. Very briefly, because Wole is already on my neck.
Okay, so in 1 minute, so a lot has been said about the monetary side of things, but to be honest, I think the monetary, they're a bit handicapped or a bit limited in what they can do, because they can only use monetary policy tools. And I think, in my own estimation, I think the Apex Bank, the CBN, I think they've done a lot in terms of stabilizing the economy. So we need to see some complementary effort from the fiscal side, anything that can bring in FX, USD, and that means you need to get FPIs comfortable. There need to be an enabling environment, and that will speak to things around insecurity, things around stability of the exchange rates. So for FPIs, they're not too bothered about where the exchange rate is. They want stability. That helps their planning. So things that can augment the external reserve will help policy.
Okay, thank you very much. I'd like to thank my panel. Ladies and gentlemen, I hope you enjoyed that conversation. My name is Rolake Akikube-Filani, and it's been my pleasure moderating this distinguished panel with Doyinsola Ola, Abiola Adejiro, and Bolahon Aino. Thank you very much.
Thank you. Thank you very much to our panelists. If you can please just stay on stage, I want to invite the group managing director of Cordros to join them on stage for a group photograph. And he would stay on stage because he will be speaking next. And just as I wait for them to finalize on the photograph, small tweak to the flow. As you've probably noticed, we haven't allowed you to take a tea break. But we imagine that maybe you need that comfort break or grab some coffee. So what we want to do is that as we proceed with the next item on the agenda, you are all free to just, I know many of us have already done that, but grab some coffee, maybe some finger food, and come back to your seat. Because one of the things we're thinking about is we don't want to keep you here longer than necessary, because we know that with the proposed strike tomorrow, some people may want to get out quickly, and we're still going to feed you with lunch, so we want to just try and be as efficient as possible. So I hope that works for everybody. Thank you again to the panelists. Please, another round of applause for them, to them.
Okay, thank you. Thank you very much. Yes. Okay, thank you very much. Thank you very much, everyone, for finding the time to come for Cordros Wealth Summit 2024. I mean, it's very important to thank you because I know there's a lot of uncertainty, in Nigeria at this time, especially today and tomorrow. So for you to find the time to come here today is really very important, and it's a big deal to us. I know a lot of people are preparing for tomorrow. So many people want to go home early, and so many people are ready for tomorrow. to either join or to stay at home. But because we have a lot of wealthy people in the room, I know a lot of you guys will spend time counting, where is my bank account? What is it doing? So, well, whichever side you belong to, I wish you the best. And thank you for coming. So for this year's theme of Cordros Wealth Summit, the Wealth Revolution, I want to thank all our speakers and panelists who have done a lot of justice to this year's theme. And I want to recognize especially the keynote speaker, Mr. Elias Igbenakizwa, the group managing director of Globus Bank. Thank you very much for spending that time with us today. I think he's left. If you don't mind, please, can you give him a round of applause? And I also want to thank Mr. Tilewa Adebajo, Linda Queno, Charles Robertson. I want to thank Mrs. Abiola Adediran, Rolake Akinkunbe Filani, Wale Famrewa, and of course my colleagues, Doyin Sola, Ola, and Gbola Waino. Please, can you please help and give them a round of applause? And before we go, we are going to have a series. Agbeyi, a partner at PwC, who is also going to talk to us before we close the session. So I won't spend so much time, but to let you know what we have done in Cordros in the last 1 year. As you all know, we are an investment banking and investment management company. We have 6 businesses within the group. We have the securities trading business, Cordros Securities. We have Cordros Asset Management. We have Cordros Capital, which is our investment banking business, Cordros Trustees, Cordros Insurance Brokers, and Cordros Registrars. Those are the 6 businesses we have in our group. And you know that we are a big player in the business. Okay. We're a big player in the capital market, and we continue to compete favorably in all the 6 businesses that we currently operate. In our asset management business, which is, the business that is organizing this conference, within the last 1 year, we have grown our asset under management by over 100 billion naira. So in our journey to being a leader in the industry, we have close to 300 billion naira under management, on our assets. So you can be sure that you have a company, that has the expertise and the people and the governance, to ensure that your wealth is not only preserved, you are able to transfer that wealth with our expertise, to the next generation. So just stick around, because I know a lot of people want to leave because of what's going to happen tomorrow. While we see ourselves to the end of this conference. We are launching our wealth report, anywhere from now. Then we're going to get a series to come, and of course we can have, lunch after that. So thank you very much, and of course, this is an annual event, and I hope to see you again, next year. Thank you.
Thank you very much, Mr. Agbenyogi, for that. So we are moving on now with another highlight of today's program, which is the launch of the Wealth Report, Compliments of Cordros. So I'd like to invite to the stage now Arnold Dublin Green, Chief Operating Officer, Investment Officer rather, at Cordros Asset Management, to handle this segment. A round of applause for him as he comes, please.
Thank you. Good afternoon, ladies and gentlemen. I am thrilled to present the first edition of the Cordros Wealth Reports, tailor-made for ultra-high net worth individuals and industry practitioners. The report provides deep insight into current trends, highlights key investment opportunities. As we navigate through the many challenges of investing, Cordros Wealth Reports offers tools to help preserve, grow, and transfer wealth. I'm sure you'll all agree with me that sometimes investing can be like walking a tightrope. Well, the Cordros Wealth Report is here to give you a safety net. Lending thoughts and ideas from various contributors, our aim is to guide you through the complexities of investing while minimizing risk and preparing for the greatest wealth transfer in history. So please join me as I count down to the launch of the Cordros Wealth Reports.
Back again. I mean, this is one of those things I'm very proud, about Cordros. And this report has taken us over 2 years to prepare. And because we like to do things, in the appropriate manner and to be sure that the quality that comes out of Cordros, is what our clients will be happy with. This is a compendium of, write-ups, intellectual discussions, and topics that will help your wealth journey. And I mean, I really can't put a figure to what this report is worth, but we intend to issue this report every year. And what we'll be discussing will be, new developments in the financial services industry, especially as regards, the wealth management industry. So as we launch this today, I want to enjoin you to find the time during this holiday that we are going to be having, because I know a lot of you people, it is holiday time, for you. So spend the time, to look through this. And a lot of people that we have as clients who are wealthy clients, you have the new generation coming up, your children, your brothers and sisters, your nieces and nephews. Encourage them to read this because you're going to be passing that baton to them whether you like it or not. Now, you have young people who are not really interested in what they are doing, and you're going to be trusting, remember what the liar said, 90 trillion assets to these young people that manage. I'm sure you have children who are first class in economics, but they want to be musicians. You have children who are first class in other, topics, but they are not interested in finance or anything. But this will help you and them because you can sit over coffee or tea and go through this together with some of your Cordros wealth advisors and get them to really understand what the future lies and where the future lies in managing wealth. So Cordros Wealth Report 2024, I am encouraging you to read it, and of course this will be an annual event. And I want to thank, my colleagues who have spent a lot of time putting this together. We have disagreed, we have quarreled, we have done all sorts of things, and I could be troublesome sometimes, before we got this, final copy. Thank you very much, and I hope you find this very useful.
Thank you very much, Wale. We'd like to invite many of the contributors to this report. I'm sure by the time you take a look at it, it's a really important contribution to the wealth management business in Nigeria. So please, if can all the contributors come to the stage. I think Bola, I know the GMD of Cordros Asset Management also should join them on stage for a photograph, please. Some of the contributors are PwC Nigeria and a few other partners as well. You want to say something about that? Because I didn't.
Okay, just to thank and appreciate all our contributors. We had contribution from diverse professionals. So PwC is Siri, but she has a representative here. Abiola Adedire also contributed. Then Overture, which is Dapo, he contributed on augmented reality. I think she read his report. I can also experience live augmented reality with your phone in the report. So there's a page that is on augmented reality. You have to download the app and you experience augmented reality live. So I think, yeah, the others are not yet, so we'll just go ahead and take the picture.
Bola did mention Overture. He does have an exhibition of augmented reality art. As you do take tea and coffee, please take a look at it. I think you'll find it quite interesting. And I also want to announce as well that if you would like to take some tea and some finger food now, you can do so. We just have one more presentation on wealth management, and then we should be done for the day. But as that goes on, you are free to, as I mentioned, take some tea, coffee, and some finger food. Right, so we'll be now having a Siri Agbeye, partner at PwC Nigeria, delivering a presentation on wealth management, providing an overview into that space. I'm sure you'll find it quite informative. So can we have a Siri?
Setting up this platform, and today I really want to spend some time just speaking to the topic that has been given me on economic resilience and wealth and how family businesses can adapt and succeed. My name is Siri Agbeye, and I'm the family business leader for PwC Africa, sitting out in Nigeria. One of the reasons why we think this is very important is because of the position that family businesses occupy the world over, and the statistics do not lie. Family businesses are often seen as unique entities with distinct characteristics that can influence their performance compared to non-family businesses. And for economies that are focused on these kind of businesses, they have a lot to thank those family businesses for. Nigeria is not excluded. Next slide. One of the things that we see when it comes to the statistics on them is family businesses contribute about 70 to 90% of the world's GDP annually. In terms of employment, they contribute about 50 to 80% of employment. And 90% of global businesses are family businesses, while 70% of SMEs are family businesses. So what you find is that there is a long continuum, or a huge continuum of family businesses, ranging from your global corporates to even the mom and pop shops that are SMEs. They all contribute to these statistics that we have, and therefore a very important part that, any country should not ignore. As we move ahead, we also start to see that closely associated with that is some of the wealthy guys that have founded these family businesses. And what you find is that the wealthiest 10% of households hold 56% of the world's net wealth, and that's also very closely linked with family businesses. Same for also the philanthropic funds, and we see how sustainable philanthropy is playing a key role in addressing socioeconomic needs, whether in partnership with governments or even on their own through charitable contributions. But I think the focus really is around development. Globally, we have a higher number of ultra-high net worth individuals, from 4.2% in 2023, and most of that wealth is around family businesses. Now, what it means is it's important to start to understand the features of these family businesses and also understand the challenges, because that's where the opportunities lie when you think about how they grow or operate through tough times. One of the things we see about them is their long-term orientation, and the fact that most times family businesses prioritize long-term success over short-term gains. It's the reason why they outperform non-family businesses. That long-term orientation definitely lends its hand to stable growth and better resilience during economic downturns. Number two is the strong loyalty that comes from the employee group. So it's very unlikely that family businesses lay off their employees. It might be that they reduce salaries, but what you find, as we saw during even the pandemic, is that a lot of businesses held on to their employees. And then there's that loyalty because of the familial ties that tend to grow within family businesses. If you just look through your markets, the retail markets in Nigeria, you can see that familial bond that's grown between the founders of those businesses and those that work for them, that sometimes are seen as children. You start to lose that flair as you get into the formal sector, but it's something, a strength or a premium that one must not do without. And that's where we see some of the success factors in global corporations the world over. In terms of investment in innovation, some family businesses are very conservative when it comes to that. But we see a strong commitment to innovation in certain sectors, and perhaps you might see that more in technology and less in other business sectors. But then you find that there is a premium that's given to the innovation driven behind those family business founders. In terms of customer relationships and reputation, there is an emphasis on building strong customer relationships within family businesses that tends to give them that power base. And lastly, decision-making, speed, and flexibility. When family businesses start in their early days or in those first generations, you find that it's very easy for the founder to make those decisions fast. There can be a trade-off, however, when those family businesses move into more generations and where they embrace more governance. And then the trick to that really should be around how do we ensure that the governance structures that we put in place don't reduce the speed with which we make decisions. And so I think this is very then closely tied with the challenges that then could potentially hold the gains that family businesses or unique features that family businesses have. Most family businesses grow to a point where they feel that the founder feels that he should hand over the business to their children. And so the children then become the next generation. But the question is that really the right equation for that family business? Should it be a family member that takes over the business? Or should it be a third party that takes over the business? All of that lies in something we call succession planning. And that really is where the challenge is. Because family business founders are so passionate about their businesses, and there is a huge sweat equity that has gone into building their family business, it's not unusual for them to feel or think that this should traditionally just go to my child. And this is where setting a boundary between your personal gains and corporate personal gains or assets falls in. It all lies in how you go about your succession plan. And that can be a challenge. And sometimes conflicts as well present challenges to family businesses. Sometime later in this, we might look at the Ambani brother, where we experienced those kind of conflicts that could potentially have altered the structure of the family business. But we'll see how they overcame that tide as well. We see that also with Adidas and Puma. Some of us might not know that Adidas and Puma are actually brothers, and that they had a very long, age-long conflict between the two of them. But fortunately, we had two strong brands that survived the conflict. What are some of those conflict resolution mechanisms that families need to put in place to ensure that family wealth continues to grow beyond generations? What about loss of control and limited access to capital? Most family businesses tend to rely on their internal funds and do not use or take advantage of external funding in growing their family businesses. But what we also find is that because they're not big corporates, sometimes they may not have the credit necessary to get funding from some of these businesses. And it's also down to documentation. What kind of documentation does one have? What kind of control do we have over our assets and resources to ensure that it does not affect the credit ratings that we could potentially have with these third-party financing bodies? Public governance and corporate governance might also be another challenge. And it's something as well that family businesses need to start thinking differently about, because while on the one hand, you find family businesses now starting to take steps towards concretizing governance within the corporate structure, the same cannot be said for the family side, and ties from the business ties. What about trust with stakeholders? That could also be a challenge that family businesses must deal with, especially where you have a lot of social economic capital or social wealth attributed to the founder. Can the same be said then of the next gen that takes over from them? Do they have the same kind of relationships with the political clout or political stakeholder group within the economies that they are operating? Will they be able to chart the same type of territory that their parents have charted when they take over in the next gen? And same questions can be said about even professional members who take over those family businesses into the next generation. And last but not least is probably over-reliance on internal funding, where you tend to find a lot of family businesses shying away from debt and not definitely taking advantage of the leverage that can be had, or not even inviting perhaps private equity funders to being part of it, because there is no alignment in terms of what their long-term aspirations are, and also the short-term in quote aspirations of private equity funds, where you have large assets to invest. And so these challenges prevent family businesses from either being the global corporations that we know, or prevents them from also going beyond the founder's generation. So if you look at this slide now, you see two worlds. One where we have the Nigerian family business, mostly in the first generation still, but you have global family businesses that have outpaced that and gone beyond the first generation, but also gone beyond their immediate communities and now investing in continents over and above just their countries. And sometimes it might be that the family businesses that we know in Nigeria are perhaps just doing it on a Pan-African basis and not necessarily looking at other continents. But where we want to be is really a global footprint. And some of the structures that these global family businesses have taken on board, are things that Nigerian family businesses can also consider, more especially in trying times, in tough times. There are success recipes that can be employed. When we look at the economy today, there are so many headwinds that family businesses are not isolated from, and they have to deal with as well. Whilst we recognize that family businesses do have that premium over non-family businesses, they also must do this within the economies they operate in. And when we look at Nigeria, there's so much that you have to contend with, whether it's from the growth rate that has now hopefully been upgraded to about 3% in Nigeria, to the exchange rate where we saw significant devaluation of the currency, and so a lot of recognition of exchange losses. For businesses who are also very import dependent, you can imagine some of the losses that are reported, and we've seen that mostly in the consumer industry space. What about the MPR rate? And then inflation as well. And so you're fighting with, how do I increase the prices of my products so that I can still maintain a decent profit margin whilst reducing the cost at hand? Do I lay off staff? And like we said before, most family businesses tend to have that strong tie to their employee base and definitely may not necessarily lay off their staff, but struggle with it. But then there are other levers that need to be considered. How is my dividend policy? What kind of dividends am I giving to shareholders? Am I reinvesting that dividend? What are the trade-offs that need to be made so that I'm still floating above water? When we go into the next slide as well, we start to see some of the strategies that other family businesses have taken on board. And I just want to focus a bit on the Ambani family business. The Ambani family business is the one associated with the Reliance Industries, a very diverse group that cuts across petrochemicals, oil and gas, telecom, retail, and even the financial services. And currently that business is driven by two brothers who at some point were at war, with one of them now having to deal with the oil and gas business while the other is focused on the telecom business. But it took the mother to be able to resolve that conflict. Otherwise, what the founder, Rebani Ambani, had built could easily have been destroyed with the conflict that had been had. But I think for the purpose of this conversation, it's really to look at some of also the tides that they had to deal with between 2005 and 8, ranging from the global financial crisis to the economic downturn, a sharp decline in stock markets, and so that would definitely have affected the value of their businesses, tightening of credit, and very high inflation rates. Some of the resilience strategies that the Ambani family business took on included diversification, and you see that even in how widely spread the family business is, so that those businesses could potentially be hedges, for the group as a whole. Innovation and technology was employed, sustainability initiatives taken on board, strong leadership and governance was something that they dealt with. And you see that also even on the family side, where you had the family leader taking a position that would help the brothers manage the business side. So family governance, and you see that construct also playing alongside corporate governance. Community engagement and social responsibility was also one of the strategies that they employed. Now, if we come back to some of the statistics that we're now seeing when we look at the Nigerian space, it's telling a story that says there are opportunities that Nigerian family businesses can use or can take advantage of, similar to the Ambani brothers, or even better than the Ambani brothers. And some of the survey that PwC has conducted has highlighted some gaps that could be opportunities for Nigerian family businesses. Number one is on succession planning. Only 25% of family businesses in Nigeria have a succession plan. This isn't good enough. This isn't ideal, and something that we can actually use now as an opportunity. Who's the next person online to take over the business? Do they have the same social capital as the founder? Do they have the same political capital as the founder? Do they have the same intellectual capital as the founder? If they don't, Where are the professionals that we can onboard to take that business to the next level? And I think for Nigeria, we're really at a point where the gears will now be changed from the current generation who's leading most of the family businesses in our space to the next generation. A lot is going to, be tested in this period, added with some of these headwinds that they're going to have to deal with. Number two on family governance is only 50% of family businesses in Nigeria have governance policies. The other 50% have no governance policies. And what are some of these governance policies that we're talking about? A family constitution. Do you have a family assembly? Is there a format or a forum through which family loyalty is enhanced? Is there a format through which we can ensure that family does not interact with business wrongly? Is there a family office, as an example? On ESG and DEI, 85% of family businesses do not have a clear and communicated ESG strategy. In the world we're in, where sustainability is now ranked higher by corporate financiers and even private equity funds, businesses cannot do without an ESG strategy. And so to be able to rise above some of these tides, it's important that businesses start to think about more innovative products, more sustainable markets and products, or even supply chains for staying afloat. Digitalization is another key area. 73% of next-gen leaders believe that Gen AI is a powerful force for transformation. The next gen is a force that you cannot do without. We call some of them Gen Z now, but the truth is that the founders of today will have to hand over to the next protagonists who are the next gen. And this next gen are informing some of the changes and transformations that also need to be made in current family businesses. It can't be business as usual. And so for family businesses that have not started to think about what their tech strategy might be, they really might become extinct. Think about Kodak, think about Nokia, think about businesses, BlackBerry, that have gone extinct. These were family businesses one time that were, had a very strong premium or brand in the market. And I think the statistic on next-gen involvement is even the most worrying for me. When we surveyed and looked at how next-gen were involved in businesses, we only found that 38% of next-gen are involved in family businesses. If only 38% are involved, what are the reasons why they are not involved? And it's some of the things that we also do through our Next Gen Club to just kind of distill those ideas and try to look for a way to have these conversations happening constantly. And that leads to trust as well. Only 49% of family businesses do not feel fully trusted by their customers. And it actually starts from within. Where there is no trust within, there can be trust without. And one of the things that the Headlands Barometer measures is the trust premium for family businesses and non-family businesses. And what has been found over time is family businesses have a higher trust premium over non-family businesses, over the government, over regulators. And family businesses, therefore, are the ones we need to be focused on now for even addressing issues around the inequalities and trust gaps that we see in markets. How can we elevate family businesses to that position? This is something that should not be ignored. And so as we start to close and identify how family businesses can be resilient in the face of uncertainties, one for certain is setting up proper family and business governance structures. It's not just about putting a board in place within the corporate organization. It's also about putting a parallel board within the family itself. Because like we mentioned before, it's really making sure that there are healthy boundaries built between the family and the business, and not one where the founder passes on, there is a will that says that these assets should pass on to this kid, and the kid has no clue how to even manage the business. It's not really about being the firstborn. It's about being the one with the right techniques and merits to assume position within the organization. And to the extent there is no family next gen, it can be a professional that takes over, takes charge of that business until such a time when a family member can be involved. We've seen that over, and this kind of selfless assumption of leadership within organization is what has caused global family businesses to move beyond the founder's generation. Strategic planning is important as well. Over and above short and mid-term planning, how can we start to do long-term visioning for the businesses? Diversification, as we saw in the Ambani brothers case as well. How can we start to diversify? How do we occupy the full length of the supply chain, whether it's through backward integrations, vertical or horizontal integrations? Cost management is definitely something to think about. And I think to add on that, it's really around, do we even have a dividend policy? What are some of the costs that we need to do without? How can we ensure that personal costs are not running into the corporate space? How can we separate those? And then innovation and R&D investment as well to stay ahead of the curve. And so as we close, to all family businesses really, there's a lot of things that need to be prioritized now as we deal with some of these tough times. If you're sitting there in the room, perhaps one question you want to ask as an example is, do I have a will? Have I considered whether there is a need for a will over a trust or vice versa? Do I have a proper governance structure? Do I have the right strategy that can take me to the next level? Do I have the right successors identified within the business and outside the business? From a tax standpoint, do I have a studied tax structure that can ensure that I'm not losing value through some of the tax assessments? As you've seen, there's a windfall tax that's just coming on board that's going to be hit on banks, 70% of the windfalls from the exchange gains that they made. These are some of the strategies that governments are using to manage their own budget deficits. And family businesses are not isolated from that. They must also plan. They must also innovate. They must also take on board technologies to stay ahead of the curve, whether it's from diversifying their operations as well across countries, e.g., taking advantage of the Africa Free Trade Continental Agreement to start to export to other jurisdictions, or even infusing more capital beyond their internal fundings to ensure that they can leverage debt and still surpass non-family businesses. Fostering strategic partnerships is important, and prioritizing sustainable growth and a long-term vision is also critical. I hope that this session is very useful to you, as I've seen over the years, just investing time in family businesses. For us at PwC, we do recognize that this is a strong bedrock of the Nigerian economy, and it's something that we can't do without. And maybe just to leave with an example of what's going on in the UAE. The UAE has invested in having a family council, for instance, that's focused on ensuring that conflicts in family businesses and just ensuring that the transition to the next generation happens seamlessly. This is an area that I think Nigeria also needs to start to focus on. Paying more attention to family businesses can give us an edge in terms of our GDP growth, because family businesses contribute significantly to the GDP the world over. And I think Nigeria can benefit from doing some of this, but most importantly, ensuring that beyond the first generation, where we've identified successful brands now, we need to start thinking of how we move from the first generation to the next and the next and the next. Thank you so much for this opportunity, and I'm available for questions after the session. But thanks again to Cordros for bringing together this very beautiful platform for engaging family businesses. Thank you so much, and have a good one.
And I hope you found it quite useful. It's been a long day, but I think we've come to the end now. Just for your information, lunch is served. You'll make your way through that door, but before we do that, I have to welcome now Bola Aino, Managing Director of Cordros Asset Management, to deliver some closing comments and vote of thanks. Please, a round of applause for him.
Okay, good afternoon, ladies and gentlemen. And special thanks to everyone that has waited this long. I believe it's been an impactful event. I also want to use this opportunity to thank all those that contributed to the wealth reports. Like my GMD said, I think it'll be a good read for the weekend. There are a lot of invaluable insights in the reports, current market trends, investment opportunities. A series also wrote in the reports, and I believe you're going to find it very, very useful. So thanks again. This is Cordros Asset Management. We are licensed by the SEC, Securities and Exchange Commission. And of course, this program today is a curated event for our private clients. So it's an exclusive event, and everyone that has come today is because you are important to us. And thanks for doing business with us all this while. Thanks for your patronage. And I think very important as well to thank you, despite the change in date, because it was initially meant to be 1st of August. You were able to accommodate the change in date, and that's very, very thoughtful of you. So thank you very much. Lunch is served, but as we go for lunch, there's a 1-minute video by Overture, which speaks to the augmented reality. And he has some artwork as well that are available for sale. So please visit the stand and just express augmented reality. So please just play the video, and thank you once again, and enjoy the rest of your day.
It's like my waking thought. I need to get this print. I need to be looking at it every day. I need to get it. It really, really speaks a lot to me, and I love it. So keep doing what you're doing. It's amazing. Please send me the information. Send me your account number. When can I get it? I need it as soon as possible. Thank you.
Oh, my body is sweating.
You wouldn't understand, but I really, really love your work, and it really spoke to me. And I'm sure you heard this a lot, but I haven't been able. Every time I sleep, it's like my waking thought. I need to get this print. I need to be looking at it every day. I need to get it. It really, really speaks a lot to me, and I love it. So keep doing what you're doing. It's amazing. Please send me the information. Send me your account number. When can I get it? I need it as soon as possible. Thank you.
Oh, my body is sweating.
You wouldn't understand, but I really, really love your work, and it really spoke to me. And I'm sure you heard this a lot, but I haven't been able. Every time I sleep, it's like my waking thought. I need to get this print. I need to be looking at it every day. I need to get it. It really, really speaks a lot to me, and I love it. So keep doing what you're doing. It's amazing. Please send me the information. Send me your account number. When can I get it? I need it as soon as possible. Thank you.
Oh, my body is sweating me.
You wouldn't understand, but I really, really love your work. And it really spoke to me. And I'm sure you hear this a lot, but I haven't been able, every time I sleep, it's like my waking thought, I need to get this print. I need to be looking at it every day. I need to get it. It really, really speaks a lot to me, and I love it. So keep doing what you're doing. It's amazing. You send me the information, send me your account number. When can I get it? I need it as soon as possible. Thank you.
Oh, my body is sweating me.
You wouldn't understand, but I really, really love your work. And it really spoke to me. And I'm sure you hear this a lot, but I haven't been able, every time I sleep, it's like my waking thought, I need to get this print. I need to be looking at it every day. I need to get it. It really, really speaks a lot to me, and I love it. So keep doing what you're doing. It's amazing. You send me the information, send me your account number. When can I get it? I need it as soon as possible. Thank you.
Oh, my body is sweating me.
You wouldn't understand, but I really, really love your work. And it really spoke to me. And I'm sure you hear this a lot, but I haven't been able, every time I sleep, it's like my waking thought, I need to get this print. I need to be looking at it every day. I need to get it. It really, really speaks a lot to me, and I love it. So keep doing what you're doing. It's amazing. You send me the information, send me your account number. When can I get it? I need it as soon as possible. Thank you.
Oh, my body is sweating me.
You wouldn't understand, but I really, really love your work, and it really spoke to me. And I'm sure you hear this a lot, but I haven't been able. Every time I sleep, it's like my waking thought. I need to get this print. I need to be looking at it every day. I need to get it. It really, really speaks a lot to me, and I love it. So keep doing what you're doing. It's amazing. Please send me the information. Send me your account number. When can I get it? I need it as soon as possible. Thank you.